drop a hello in the chat if you're with us. All right. Let's see here. I do see us live on X. And let's just give a little check to the YouTube crowd. Drop your orange dots in the in the chat if you're with us. Okay, I do see the crowd there. Someone in the chat saying, I hope Michael Saylor has a big announcement for strategy today, and so do I. So welcome to the Bitcoin Treasuries.net live stream. We're breaking down strategy on earnings day. Of course, that call is going live at 5 p.m. Eastern. We're going to get live results that are dropping at 4 Eastern in about 25 minutes here on strategies. First quarter results, of course, because of the price of Bitcoin didn't cooperate from January 1st to the end of March. We do expect a little bit of a loss on strategies earnings that they have to report as they mark down those assets. But, big news, guys, for strategy in Q1 of 2026 so far. Yves, I'll throw it over to you. Of course, I'm here with Yves Andre Graf from the One Share Pod, Quentin from the One Share Pod. I got Michael Geraci from SD Markets, SDM, and Tim Kotzman. You know him from everything Bitcoin Treasuries. Welcome to the show, guys. And Yves, I'll throw it over to you first. What's the biggest story of the first quarter for you as far as strategy is concerned? What have you been most interested in?
Yeah, I think it's quite obvious, and I think probably most of the people were looking at the same thing. It's obviously STRC hitting par quite some volume, especially on the week before.
Looks like we lost Yves there, but yeah, STRC is definitely the biggest story. Quentin, do you want to take it away on what you've been seeing with STRC and how Michael Saylor's been able to, kind of just basically turn on the ATM printer for that instrument?
Yeah, sure. So I think what's really interesting to see on STRC is the switch in funding capabilities of strategy, right? If you compare to Q1, it was around 80% common stock versus 20% of the prefs, mostly STRC. That's how they funded their Bitcoin in Q1, and now in Q2 it's completely reversed. It's 80% STRC and 20% common. So I think we're really seeing. At Strategy World, it was quite clear that they really focus on STRC as a product going forward, and we're really seeing that reflected in the numbers right now. And I wonder if it's going to keep going that way, or if we'll see a reversal again. But it's really strong what they're able to do currently on STRC.
Yeah, it has been really strong seeing what they've been able to do with STRC. Michael Saylor and Fong have both talked about how there's about 80% of the total volume in Stretch has been retail. A lot of that's probably family offices, some smaller funds, and the everyday retail investor. Was that surprising to you, Tim, to see how Stretch has taken off so quickly? With the retail crowd.
I guess on one hand, I'm surprised because I just had heard in private conversations that a lot of this is more institutional than what you would think just scrolling X all day long. But on the other hand, I mean, Strategy and Strive have done such a great job of really amplifying the message through 1 million podcasts, however many podcasts Saylor has done, and now Fong and the whole team over there. I guess it shouldn't be surprising, but I think it's important to have a mix of both. And I have some thoughts as to things that I think would be interesting for them to announce on the call, questions that I hope some of the analysts ask on the call, but maybe I'll save that for later.
Yeah, that sounds good. Nice tease there. And I'll throw it over to you, Michael. We were talking before the call about, famously, Strategy can't fund these dividends through their operating business alone, just given the way that these preferred equities, particularly Stretch, have grown. They have shown, ability to access capital markets through their common equity ATM. What's interesting to you as someone who's in the derivatives trading, with that framework, seeing this company expand their balance sheet so rapidly with a small overall operating business outside of Bitcoin?
Sure. In the sense of traditional leverage metrics, strategy is in a very good space. There's no systemic risk to them with their Bitcoin assets. So assets and liabilities, they're in good shape. To me, the framework should really be around interest coverage and really kind of lifting the hood under and looking under the hood in that regard. So we know that they have about $1 billion annually in preferred stock debt covenants they have to cover. So interest coverage is simply just looking at EBIT divided by interest expense, and we know that that strategy really doesn't have any earnings outside of their AI business, but that's just a drop in the bucket. So that's really the concern, and I think that's how this should be framed here. So it means to the stakeholders, it means a couple things. And there's only really a handful of possibilities and states that I think could come out of it. Bitcoin goes up forever and funds its obligations. So that keeps the flywheel alive. And that's a great scenario, but highly unlikely. Otherwise, they may have to cut dividends. Another option they may have to take is they sell small amounts of Bitcoin each year to fund their annual obligations. Then it kind of crosses the line of we never sell Bitcoin, story breaks. Yet outside of that, I think what's really fascinating in terms of volatility is the whole dynamic of strategy offers a lot of yield opportunities. So in MSTY, which is their income fund, MSTY being the symbol, you can have Bitcoin exposure at about 2 times upside beta and 2.5 times downside beta, and get paid a very handsome yield to do that. So right now, MSTY's paying about 80% annualized. Last year was 250%. So I think that's a really kind of alluring type of product and option space to be in. Also, if you own MSTY, you can just enhance your yield by selling calls against it. So there's the whole dynamic and presence of strategy really offers a lot of pretty fascinating income opportunities.
Yeah, absolutely. It's been kind of fascinating to see, and the yield is certainly there for MSTY, MSTY, Michael. But how do you feel about like the total return? As Bitcoin price got shellacked and Strategy's price got hit, obviously the principal return on that's gotten clobbered as well. Is that just the risk you're taking when you're trading an instrument like that, or is it more of a dipping your toe in for yield here and there?
It is, and I mean, of course, that's the whole nature of the downside beta, and that's the price you're going to pay of taking the risk to get those enhanced yields in the option market. So now that looking back post October 10th, and the whole vol regime has changed, and the market's found some stability. I personally like the idea of owning MSTY, and again, using covered calls to even enhance your yield some more. So I think it's a good space to play. And again, you're getting synthetic Bitcoin exposure. So I think it's worth the downside risk to and getting paid that yield to own the cash in MSTY.
Yeah, it's been pretty wild to see, all the products that have kind of been built around strategy, and I think Saylor and the team and Fong are always highlighting those because they're kind of laser focused on providing this digital credit and securitizing basically it de facto with the Bitcoin on their balance sheet. But there's been a lot of players stepping in with ETFs, covered call strategies, yield strategies, and of course now we've got Apex and Saturn and the like that are collateralizing stretch for crypto native people. What's your take, Yves? I'll bring you back in on this. We lost you earlier, but what's your take on I guess a couple things. What Michael said, as far as funding the dividends, I've got Strategy's website up here, which shows their a current snapshot. They've got about 44 years of dividend coverage. That's based on the current Bitcoin price, of course, and the model really is a carry trade, right? It's that Strategy is going to be able to arbitrage this perpetually high CAGR and manage the basically the interest rate on STRC as they can adjust that up and down 25 basis points every month. So what's your take on the long-term strategy? Of course, I think most of us are pretty bullish on Bitcoin long-term, and these other products like Apex that have poured a couple $100 million into STRC in the last few months.
Yeah, so as you mentioned, we're all bulls here on Bitcoin, obviously Bitcoin maxi. So as long as the government keeps debasing the currency, I think Bitcoin just goes up forever. So this probably will not change. And this is basically the status quo. And that's obviously just puts the whole strategy into play. And as long as this happens, they can fund indefinitely those dividends, because all of these products that Strategy is building on top of Bitcoin are very, very interesting for anybody, really. Obviously, we mentioned now retail, but you can already start seeing institutions coming in. And again, coming back to what you mentioned, for example, the Apexes of this world who are building on top of STRC. I mean, this is just, we haven't even scratched the surface. I mean, the other day I was talking to Quentin about how can you even enhance your portfolio with STRC and SATA. And I think once people start realizing all the things that you can start doing with it, there's going to be a slew of new ideas that are going to come, and everything will be built on these digital credit products. And again, I think also Jeff Walton, he was positioning this from an insurance perspective. So it's everybody can start pitching into the financial services and start building around that. It's just that we haven't started seeing that yet, right? I think right now, obviously, we've seen some crypto tokens being built on, but this is just the beginning of it. And the more I look at it, and the more I see these products, and I start driving my head around, it's going to be crazy to see. And I think the market will just grow tremendously.
Yeah, it is crazy to see. I want to shout out some people in the chat. We've got Dana Hawaii in the chat saying, aloha, he's only here for the orange chais. And I got to thank Tim, always being generous, lending out the orange chais, passing them out for all of us. So thanks there, Tim. We've got Sandeep Star shouting out the One Chair boys in the house. He's a big fan of the One Chair podcast. So thanks for joining, and join along with the hijinks, guys. Leave your comments and questions for us in the chat. Just thinking about basically, what strategy has been able to build with Stretch in the last, it's still less than a year old. We kind of forget that it was just last summer when Stretch launched, and to see them raise billions of dollars in the last quarter and a half has just been absolutely wild to see. It's I think the largest preferred equity by almost 2 times in the U.S. stock market. And I was talking with someone yesterday who said, preferred equities were kind of like the redhead stepchild sometimes, and more of a sign of distress sometimes, or lower yield, or junk rated with some high credit risk. But to see a product like this grow to the size it has, I think is something pretty wild to see. Do you have any thoughts, Quentin, on do you think this is a sustainable pace for the amount of capital that Stretch has been able to raise, especially in a Bitcoin bear market? Or do you see this exploding as Bitcoin's price rises?
Yeah, that's a good question. I don't know. It's been great to see that the Stretch has been continuing to grow, even though they kept the dividend stable now for the last 2 months in a row, right? We're seeing Stretch is almost back at par, but for 2 months they have kept the interest rate at 11.5. Before that, it's the investors could expect a raise every month, right? It was quite consistent for quite a long time through the bear market, and now it stopped, and still the product is performing well, right? So I don't see demand drying up anytime soon here. And as you mentioned, we're 80% retail, 20% institutions. I think this will flip as well at some point. I mean, as products get built on top of Stretch, and Yeah, I think the big one is the banks, right? If at some point they can start buying stretch and offering a savings account at 8% and capture the spread, then yeah, this will explode even further.
Yeah, we've got of course Strive in the market offering SATA, which is a kind of just a smaller version of STRC. It's got a slightly higher yield, and they've kind of pioneered um, some cash on the balance sheet to cover those dividends for a couple of years that Michael Saylor and the team at Strategy kind of mimicked, because I think the market was kind of calling for that. Quentin, you mentioned banks, and I'll throw this out to anybody. Do you think banks are going to leap in and kind of copy this? Do you think they're going to securitize STRC in a similar way that Strategy is doing and just offer a lower yield? How do you think it plays out? Maybe Quentin, if you want to jump in, like you said basically that you expect banks to do this. What does that look like for you?
I mean, I see them just taking over the last piece of volatility that we have in those products, right? Even though it's being reduced significantly, you still have, because of the ex-dividend date and the monthly payment, you still have this drop in STRC, so it's not 100% stable. And I just see them taking over this last piece of volatility and then offering a savings account that is a bit lower, and they just capture the spread. I don't know.
Yeah,
I think
that's really interesting to watch. And like you said, I do think there is going to be a flip where there's more institutional demand, especially as this product matures, and has more of a track record. If Saylor can keep the volatility low, I think the demand for a low vol yielding product is definitely pretty high. We've got famously private credit markets that have times of liquidity that are really restrictive and a bit opaque for investors. But I can see institutions as the size of Stretch will grow. I expect it to grow. It certainly seems like Bitcoin's price has turned a corner here for the short term, and I'm curious to see if the next bull market's around the corner, or if we have some more bear market shenanigans happening. What do you think, Tim? I'll throw it over to you. Are we out of the woods on this bear market for Bitcoin? And do you think the persistent bid from Strategy has shaken loose the bears?
Well, I should probably start with the reality that I'm an eternal optimist. So yes, I think we're going higher. It's just a matter of how much volatility and what direction in the very short term. We're always going to have volatility, but I find it hard to believe anything can happen. Not financial advice, but I find it hard to believe that we're going to go back down to 60 or 50 something. It just seems not what my spidey senses are telling me. So that's my technical analysis on it. I think, I don't think it's done with a light, without reason. I think it's done with a very specific reason. If you read Saylor's new pinned tweet, right, that Bitcoin, like the cycles are over, it's basically going to be pushed by digital credit and bank credit. So, to the other panelist's point, the first bank to wrap something like STRC is going to be kind of the next shot heard around the world. And just all of these ETF products. I mean, if you can go to, Chase or your favorite bank, Wells Fargo, and just open up a Bitcoin account, it seems like all good things. And that's a joke that, it's these private clients that get access to this stuff first, which is ridiculous because you can just go on Coinbase, not a sponsor of the show, Coinbase or wherever, right? River, wherever, and just buy some Bitcoin. So it's very, very funny, probably to all of us, that it's like, well, now you can buy the Morgan Stanley ETF. And it's like, all right, great. right, all great additional avenues, all good things for Bitcoin.
Yeah, it's something I think about a lot is, thinking about the buyer of Stretch, who is buying STRC, and it's like Bitcoin's right there, you can go if you can stomach volatility and you've got a long-term thesis towards Bitcoin, you can go to a exchange and soon big banks probably too, with Charles Schwab has rolled out some limited Bitcoin trading. If you can go out there and grab that volatility, it's like it's funny that there's so much capital that's either trapped that can invest in other things, like Bitcoin, or that people don't want the volatility risk of Bitcoin, but they're willing to kind of have some exposure to it and let Saylor and the team at Strategy manage that. But the demand has certainly proven to be there. So I can't say Saylor's wrong when he says this is their iPhone moment. It certainly seems like this product is something that's fueling growth for the company, and like I said, the demand is absolutely there. Michael, I'd like your take kind of on the current state of the Bitcoin market. How are you positioning with this? I know you're not going to give away your trading strategies and all that, but how do you think about the short to medium term outlook of Bitcoin? And are you in the same boat as us? On the long term Bitcoin thesis. How do you view that?
Yeah, absolutely. I'm very bullish Bitcoin long term. In terms of price, I think we've already seen the worst, going from a high of 124 to 60. So I think that's behind us. And really what I'm looking at is the vol surface. So Bitcoin vol is in about the 35 percentile level right now. So that means that Bitcoin vol is very low. It's not the lowest it's been. Yet, so the ideal option strategy right now is to be long gamma. I like buying at the money straddles in the front months, or say 1 week, 2 week, 1 month. And then you can even carry or sell a straddle in a 6 month or 9 month to finance being long that gamma in the front. So I think that's a very viable strategy. Your break evens are going to justify your break evens by shorting or carrying the Vega in the back will justify paying for that gamma in the front. And lo and behold, based on geopolitical risks and the unknowns, we're going to see gamma realize very shortly. We're going to see volatility go higher. So I think that's a very viable strategy. That's what I'm running. That's what I'm recommending to my clients. Again, you're really getting the break evens in that 6 month or 9 month straddle that you're short, and you can easily delta hedge them to hold your positions of being long gamma in front. And just a note on Stretch and just really the whole dynamic. If you relatively look at what the digital asset space is offering in yield, the basis is low. The Bitcoin basis, when you buy spot and sell futures, you're getting about 4.5% annualized right now. So that's not very attractive. That's on par with like a 10-year treasury yield. So, Stretch offers a very attractive yield in the space. So Saylor was wise to offer this dynamic to really fund strategy at this point. So so really a lot to look at from the vol space. I'm again definitely a big proponent of being long volatility, short-term volatility here.
Yeah, and it'll be nice once the volatility ramps up again, because that's especially for strategy, that's when capital markets really open up to them. So be pretty exciting to monitor that. I want to welcome Halston Valencia to the stream. What's up, Halston? From
Hey
Daily
guys,
Stock.
thanks for having me.
Yeah, absolutely. Congratulations too on your promotion there at Bitcoin Quant. You're building operations out at Bitcoin Quant, and I guess we'll put you right under the gun here with your take on. We're talking the state of the Bitcoin market right now. Do you think we've turned a corner on price, and where are we headed?
I think we have. I think we bottomed a while ago. I think we're definitely headed. I think by the end of the year we'll be back at 6 figures. I mean, maybe I'm too bullish, but That's where I'm at. I think we'll definitely see some consolidating here for a minute. But I don't know, it's hard to look at not only just the geopolitical and macroeconomic landscape, but look at what Saylor's doing with stretch. And I know I hopped in, and it sounds like you guys have been talking about that. But it's hard to imagine like the price not moving astronomically. I think he's definitely creating that $1 million coin himself with stretch alone. So I don't know. I'm pretty bullish. I try not to really look at the price in the short term too much. I see Bitcoin as long-term savings. So price doesn't affect me all that much. If you're in it for 4+ years, it really shouldn't affect you because you will make significant returns after that, regardless of current price action. So yeah, I don't know. Overall, very bullish.
Glad to hear you're bullish, Halston. I do want to talk about the move to semi-monthly dividends that's kind of pending for strategy, and I'll bring you back in on this, Yves. We've seen a lot of sell-off, and it takes time to ramp back up for these buyers of stretch and traders who are coming in and kind of arbitraging that record date for the dividend, just kind of playing off the ex-dividend. Do you think that the move to twice monthly dividends is going to be enough to smooth out some of that volatility for stretch and bring more traders there? Basically, this is going to a vote to MSTR and stretch shareholders and should be authorized June 8, I believe is the date. But what's your take on the move to semi-monthly dividends? Saylor has said that they looked at doing even more frequent dividends, but there's basically NASDAQ and SEC restrictions that prevent them from paying dividends more than twice a month on stretch.
Yeah, so I think first it's an interesting take because we were talking about how banks could potentially use STRC and then dampen the volatility, right? But I think when we get these semi-monthly dividends, we will also see some dampening already of the volatility. And when you start thinking of STRC as a product and it's barely not even 1 year old, and I consider the volatility already quite low for such an instrument, especially when you see what's happening behind the scenes with Bitcoin, the geopolitical, and it's fairly well, in my opinion. So the volatility of this product as it is already quite low. So if you're looking at semi-monthly, it's going to dampen it even more. And so the time for the banks to actually get into STRC and dampen this volatility, in my opinion, is also very low, because at some point this volatility will go away. And maybe I'm too bullish, but I think within a couple of years, there's probably no volatility on STRC. So the banks will have to offer higher yield if they're building on STRC. They cannot offer 8%. They will have to go probably 11, assuming they're still at 11.5. They will only be able to pick a very small amount of bips out of STRC to offer those products, right? So banks better hurry. That's my pitch to them if they want to actually monetize on STRC, because time is running from them. So that's one thing. But yeah, obviously there's going to be traders that are going to be looking into it, and obviously this will signify. And I think, again, going back to Jeff Walton's points about the options here, you need to have options that will be reflective of this volatility, right? I think right now the options market on STRC is so the increments are way too high. So they need to build better products on top of STRC for the traders, because there will be still interesting trades to be done on STRC, just at very small increments. And yeah.
Yeah, what do you think, Michael? Are there going to be interesting options, built around STRC for you? How do you think about that? And or is the volatility just not there on stretch to make it interesting?
I would probably say the latter. The vol is just not there on a fixed coupon type of preferred stock. That's why I kind of alluded to what else strategy provides into the marketplace, and it's MSTY. That's where you can have some very interesting volatility plays and synthetic exposure to Bitcoin. So that's where, although it's listed, that's where I default to. That's where the real volatility plays are. outside of, what I don't think Stretch really offers at this point.
Cool. I'll bring you in, Cris. We got Cris Reed here, BTC Mindset, who just joined us. We're super excited about what's happening with as MSTR kind of paints a picture on their Q1 earnings. There's not really any surprises there, but I'm curious to see what Saylor and Fong are going to announce and the team over at Strategy. We've talked a little bit about the twice monthly dividends. What's your take on those semi-monthly dividends that seem like a slam dunk to be approved later this summer?
Yeah, talked about for a long time, and Saylor and teams talked about is they wanted to get the vol down, right? So the vol started at 14, 15. We saw a couple round trips of the instrument from 90 to 100, then back down to 90 to 100 to 94, back, and it's pinballing back and ping ponging back and forth, and the vol creeped down from 15 to 12 to 10 to 8, now to around 2 for 30-day realized vol. And so this is just another step towards getting that vol even lower. And ultimately, we can get into more detail on it. The lower the vol and the higher the return. When you have a one vol asset at 11.5%, that doesn't exist. And then when you say it out loud, people are like, what are you even talking about, right? Because you're having to take more risk to get that type of return. And so that's where that conversation starts. So they want to strip that vol as low as they can, and they want it to be a very consistent instrument and do what it's supposed to do.
Yeah, well said. It'll be interesting to see how people arbitrage too the SATA dividends that are pretty likely, I think, as well to move to the semi-monthly on a opposing cadence. So you basically have 4 times a month exposure to these digital credit products to be able to stream more. I know like Apex, the guys over there who are collateralizing both STRC and SATA love that because they'll be able to generate even more yield for the people who are investing in those savings coins. Do you have any thoughts, Halston, on what these downstream kind of products that are being built on Stretch? We talked about it with the guys a little bit earlier, but I'd like your take on what people are building crypto natively and what you expect even in traditional finance as more and more people securitize Stretch.
Yeah, definitely. I think it's been interesting to see these products get built on top of Stretch. Fong was just saying at the Vegas conference that he believes that this is kind of like Stretch is the iPhone moment, and he believes that now we're going to see the AirPods come out, all the different accessories that all go back to the iPhone as kind of the foundation. And I think I agree with that. I'm definitely cognizant of the fact that it's very much a new product, and I'm trying to use some wisdom and kind of analyze like what's actually going on here. Would hate to see something terrible happen to a lot of capital, but I think that I have a friend who's building a product on top of Stretch and SATA, a little bit mixing in some T-bills in there as well. And I think overall, just my main takeaway is like, listen, guys, like the world is not the financial world is not. It's built on sinking sand, and people are desperate for something more. Something that beats inflation, right? Like your JP Morgan, your Wells Fargo, all those savings accounts are offering you something that's just a slap in the face. What is it, like 0.01%? And these products are clearly going to become more and more lucrative. And I think with this new semi-monthly dividends, and like Cris and the rest of you guys were saying, with the lower volatility, we'll definitely see more, serious allocators start to invest in these products, which ultimately just grows Stretch and then grows the Bitcoin price. And so overall, I think this is going to be fantastic, and excited to see everything that's just coming about from this one really cool product. I mean, I'm a Gen Z person. I just turned 24, and I think it's just clear to me that the world is the young people in the world are really, really struggling. And so to see something so lucrative like 11.5% is truly incredible. And personally, I don't think I'm the target audience for Stretch. I'm trying to stack as much Bitcoin as possible. But take my grandparents, for example. I'm definitely having them buy Stretch and a little bit of SATA too. And so I think that there's definitely product market fit with these products.
It looks like we might have lost Tyler, but I think we have at least a couple of podcast hosts on the screen, so we can probably handle this, right, Quentin?
Yeah,
I
absolutely.
can go next if nobody. So exactly, I think one question I would have to the round, because obviously we're talking about stretch and today's strategies earnings, but SATA is also a phenomenal product, and we've seen it also do fairly well over the last couple of weeks. And now it's, I think, even a bit rivalizing STRC. So how do you see the risk on SATA compared to an STRC? And here, I don't know, Halston, Cris, or Quentin, or whoever wants to go. Or I'll just throw it to you, Cris. How do you see that?
Yeah, I mean, it's the very top level quick take, but it comes down to the risk of the issuer. It's your trust in the issuer in the end, right? And so everybody has to evaluate in their own way as to who's issued the digital credit and are they going to operate at a high level, right? And it's somewhat semantic, but somewhat not, right? That's what you have to do. And so they're similar products, right? And then you look at the spread. If this is a pure math thing and non-emotional, you look at what STRC is paying and you look at what SATA is paying. And is there's a delta between what you're being paid, and is it worth the risk to go out on the risk curve a little bit more to get that 13% versus 11.5 or whatever the effective yield is currently? So it's a quick math, but it's also this, where is it coming from? Who is issuing it? And then do you want to take excess risk in order to get that 13%? And you can come to different conclusions.
Yeah, absolutely. Because when I look at Strategy's balance sheet compared to Strive, and not to de-Strive or anything, but I would have expected for them to reach par, they would have needed a higher dividend, which is also mind-blowing in my opinion, that they're able to reach par with 13% considering their balance sheet. But even though I'm a Bitcoin maxi, right? So yeah, we have Tyler back.
Yeah, has anyone dug into the strategy earnings yet? Let's see. I haven't seen that they've dropped. I'm just checking out their filings.
Yeah, so I had a look as well, and it looks like they're again coming back to strategy world and all the obviously the all the Saylor and Fong Li appearances. Looks like they're very much stretch oriented. It's some big highlights on stretch. So maybe I can quickly look at stretch raised. So 5.5 billion, a growth of 189% growth year to date on 2026. And yeah, so staggering numbers here, right?
Yeah, it's absolutely wild to see that capital raise. And I think anyone who I'm curious what someone who's not native to Bitcoin thinks about these numbers. Some people this has to be coming across some people's radars and at major institutions, or even in the advisory space, and they've got to be some of them have to be doing some due diligence and kind of looking into what Saylor's doing, because it is kind of crazy that he has kind of flipped this preferred equity model on its head. And it'll be curious to see if there is a ceiling to what he can raise on stretch, because at some point you've got to imagine that he'll hit his ceiling on demand. But like Saylor always says, he's the best salesman of his own product. He says the demand is everybody in the world wants a savings account that pays 10% with no volatility. So I think he's definitely right there. And Bitcoin's price is going to really have to cooperate. But if he keeps, if the common equity does outperform during bull markets, and he's able to accumulate more Bitcoin on the balance sheet, and then during bear markets, if there's kind of a flight to stretch, I think if he's managing that leverage ratio properly, that is something that he can really pull off. So yeah, I'll throw it out. What do you guys think the ceiling is on a product like this? We're Bitcoin bulls, so I tend to agree with Saylor, but what do you think, Cris? Is he going to run out of runway eventually, or what?
Well, you guys probably know where I'm going with this. because I think the part of the end game of this, whether that's, don't give me a duration on what I'm saying, but if you read my article, the apex carry trade and this concept around STRC, look, the ceiling's pretty interesting. And you look at markets over the last decades, the market sniffs out and finds the best carry over decades. That's what The Rise of Carry was, a phenomenal book, by the way. Once you understand that, and if you believe in Bitcoin, you believe in STRC because they're stripping off the vol from Bitcoin, right? You believe in the playbook, then I just don't see how this doesn't become an apex carry or one of the apex carries in the entire market when you have, if it does what it's supposed to do, and if it continues to do what it's been doing with the numbers it's doing it with an 11.5% and a 1 or 2 vol. Yeah, there's an article there. So it's something to kind of go through. And when you have that discrepancy and you compare it to other instruments, that's the thing. Like, you have to, what is it competing against? And you compare it to private equity. You compare it to other debt instruments, even, investment grade, junk bonds, and you just do, a side-by-side vertical comparison across those things. And the numbers are staggering. I mean, people don't like the whole Sharpe ratio. People get really mad when you use, it's a Sharpe ratio of 4, and they don't like it. But it is what it is as of right now. The 30-day vol, or the 30-day realized vol, is what it is. Now, is it a guarantee it's going to stay exactly where it's at? Of course it's not. It's a newer product, so it's seasoning. It needs time. And by the way, you talk about what's the ceiling. It is so early with this product. I guess people just may not understand how early it is, because there's so much capital that you can't even touch it yet. Even if the entities like the product, like they think it's interesting, it's unrated. It doesn't have a rating from Moody's or S&P. So there's capital that can't touch instruments like this unless they are rated before their desk can even come on their desk, right? And then another layer to all this is, a little bit deeper, but if hedge funds really figure this out, they can't participate right now because this is small, guys. Right now, what STRC is doing, the bigger landscape is tiny, and that's part of it too. TradFi kind of looks at STRC right now. They're like, who cares? Nobody cares right now. But they will care. They will care if it gets bigger. And I know this is such a basic thing to say, but it's all about scale. Can they get in? Can they get out? Can they come in and arb it for the dividend? Arb desks, can they do that? There's a lot of layers to that. But look, funds can tap, a 425 basis points across their prime broker, and then reallocate those units to get 11.5%. You don't think someone's going to do that? That will happen. At what scale, at what speed, I don't know, and neither does anyone else. But when you have that 700 basis point delta, I promise you Wall Street will figure it out, because that doesn't exist in the rest of the market with that wide of a delta, is my whole point with all that. Mechanically, yes, this is going to take a long time. And it just is what it is. These funds aren't, these multi-billion-dollar funds aren't just going to dive right in. There's not enough liquidity in this instrument yet. So they're going to take their time and watch it.
Yeah, I mean, it's all downstream, a function of the size of the Bitcoin market too, right? Where, we tagged above 2 trillion, in the highs of last year, and we're sitting probably 1.5, 1.6 trillion, I guess. 81,000 a coin. So yeah, 1.6. Yeah. So I mean, like, the bigger the size of that Bitcoin gets, if it's compounding at 20, 25, 30% a year over the next 5-10 years that Saylor says it's going to, I think I'm certainly bullish and close to his projections. That the size of the asset's just gonna grow. So everything downstream of it, strategy, is going to be a lot bigger. There's going to be a lot more opportunity there as they accumulate more Bitcoin on their balance sheet. They'll be competing with some of the in the multi-hundred billions of dollars of company size. That's top 100 companies in the world. And I think Saylor's got his sights set even higher. He thinks he can be $1 trillion plus company. So the conviction's certainly there. And then Stretch itself, we're at still under 10 billion in size, but yeah, once people can move in and out of that with a lot more scale, I think you nailed that on the head, Cris. That it's just gonna be pretty crazy stuff to see. I'd like to pivot and talk about what you guys think about the Bitcoin ETFs. Strategy's been kind of neck and neck with IBIT. We've been tracking for fun, on our site with the data about Strategy surpassing IBIT in size on total Bitcoin they have on the balance sheet, and inflows to the IBIT Bitcoin ETF from BlackRock were pretty big over the last week and a half. So they're kind of neck and neck, holding about the same amount of Bitcoin. How big of a game changer has that been? I think Michael, you might have some cool insight on this. Has IBIT being just a huge options market been something that's interesting for you? Like traditionally we only had the crypto native kind of derivate options markets in some futures, of course, but like to be able to play in the IBIT sandbox with how big that instrument's gotten, what's that unlocked for you?
Yeah, absolutely. A lot of opportunities and strategies. So IBIT's open interest or notional surpassed Deribit about 6 months ago, maybe a little more than that. So that's highly significant. So this brings about two landscapes of comparing vol surfaces. Of course, you're looking at a traditional finance ETF that's open 256 trading days versus Deribit that's open 365. So you're going to see some different volatility surface there. So that's really brought about a lot of cross exchange arbitrage that people are running that's super interesting. That's tending more into the woods of quantitative, more systematic trading, but that's definitely an opportunity. For the general public, it's IBIT. It's fantastic because it's just offered a runway for mom and pop traditional finance people to have exposure to Bitcoin and feel safe with custody and security of their broker. And maybe down the road that gives them the opportunity to overspill into more crypto native type of exchanges like a Coinbase, Binance, or even Deribit soon, which is going to be available to US retail. Hopefully we go in that direction. So IBIT really puts the stake in the ground with TradFi, security, liquidity. So I'm very pro. I think it's a great product. I think it really buoys the whole space, and that's really what I root for.
Yeah, I think so. Like certainly, yeah, it's hard to say we would have had the run we had, in this cycle without the ETFs coming in and the big boys bringing in some capital there. I'd kind of like your take, Tim, on what you've been thinking about. Obviously you cover Bitcoin treasuries deeply, and you talked to a lot of the movers and shakers in the space, and at the Bitcoin conference we had Jack Mallers in 21 kind of paint his vision for building this kind of Bitcoin native company, this conglomerate that's native to Bitcoin and doing something entirely different than what Strategy's doing, by attacking capital markets. Where do you think the whole Bitcoin treasury space is headed? Everyone's still looking up at the giant that is Strategy, but do you think we're going to see more treasury companies separate themselves, or is it kind of just following the Saylor playbook?
Well, I think on 21, Jack Mallers, I don't think I would bet against Jack and Tether and SoftBank and Cantor, and I mean, you could list a couple other names. I think that flywheel of having a couple of big players all, if you can kind of think about a flywheel, they're all working together and they're not, necessarily going out with a preferred product at this point, trying to bring in billions, but they kind of have some things, quote unquote, in-house, I think, that maybe Strategy doesn't. So I think a lot of people are going to be surprised. I don't know anything more than what I hear Jack saying, but I think you think about all those entities, and it's like those are thoughtful people that want to make money, right? On the ETF front, Sometimes I repost like every single one of Far Side Investors, kind of like daily flows, negative, positive, or zero. And if you look at, I just reposted the one from yesterday, total net flow, $532.3 million in one day. It's like we're focused on digital credit, and then like the Bloomberg analysts of the world are focused on the ETF flows. The thing that I think is so interesting and why I will retweet something when it has zero flows is, my point is, like, look at yesterday and think about the incentives of an ETF. Now, maybe they all have enough AUM to be self-sustaining and everything's fine. And even if not, you just look at the names that are backing these ETFs. They're not closing them down. You have a dozen solid ETFs in the market, and look at the results from yesterday. You have IBIT with 335 million, FBTC, which is Fidelity, with 184 million. Then you have BitB, 0, ARCB, 0, like BTCO, 0, EasyBC, 0, Burr, 0, HODL, 0, BTCW, 0, MSBT, 12, GBTC, 0, BTC, 0. Like, I'm not trying to be pedantic, but the point being that like the plumbing is in place, and like that $500 million number for a day, what happens when the price starts ripping? And you have big players in the market now saying 2 to 7% allocation to Bitcoin. If you would have told any of us that 5 years ago, we would all like laugh and be like, that's awesome, but also what? It's like, I have questions. Number one, what? Like, it's just unbelievable. I think, like, I don't know how they do it, obviously, but like the analyst coverage on the strategy call coming up, you have Jeff Walton, you have James Lavish, right? You have Jeff Park, really thoughtful people in the space. But the one that I think is most interesting, and of course this is just my personal opinion, is you have a Bloomberg ETF analyst on there, right? Eric Balchunas. And he, from what I see, he's posting all these ETF flows and commenting on them. And what happens if Saylor or Fong or somebody else gets in his ear and he's like, maybe you should start posting ETF flows and digital credit flows. So that's what my thought would be if I was in their seat. I'm not in their seat.
Yeah. That's a good point. Is analyst coverage is just it's not even here yet, right? It's not even covering digital credit. It's not covering strategy by and large. There's a few household names. You've got TD Cowen and a few of the others who are providing buy-side analysis on strategy. But yeah, it's like compared to the rest of the market and compared to, no one covers preferred equities, like on a Bloomberg or CNBC, but we're gonna start to see it more. I think, as Saylor spreads the good word, selling his product, yeah, it's just gonna kind of enter more and more of that conversation. And you've got people like you said, Eric Balchunas, James Seifert, who covers it in traditional markets, and even like like an Andrew Ross Sorkin, definitely he's friendly with Saylor and has him on. And I think I think it's just been hard for a lot of these analysts to wrap their head around the Bitcoin treasury strategy that Saylor's employed. And yeah, I think sky's the limit as more and more capital gets unlocked, as more and more people can allocate to this, and it just travels through those financial circles. And I think we all probably wish that things moved faster. Being in the digital space, being following an asset that does trade 24/7, 365. Things can happen fast in Bitcoin markets, and once traditional finance catches up to that, I think it's going to be time to grab the popcorn. What are you thinking, Halston? What do you think about either ETFs or the future of Bitcoin treasury companies in this next cycle? What are you thinking about?
Yeah, I mean, I listen. I know the conversation around the ETFs in this space is so controversial. I'd say I'm overall pro. I think not everyone can buy spot Bitcoin, and I know lots of people that love the IBIT, and so definitely supportive. I think it's a net positive for the Bitcoin community as a whole, and I think that's how you see mass adoption is through these different kinds of products that act as bridges. I think in terms of the future, I think we're going to see more and more companies. I think we're going to see fewer treasury companies come about, and the current ones probably just become a bit more mature. I think that we will definitely see more of these like Bitcoin super companies, if you will, like the 21 and Strike merger and all that. I think, just talking about that and looking at what he said in Vegas, I think that's really interesting because this is a different kind of flywheel. Like Strategy has their capital markets flywheel. This is a flywheel that operates on 3 independent units, if you will. They have the mining, and then their lending and capital markets. And so yeah, the mining produces Bitcoin cheaply, and then the lending helps them monetize it, and then their growing treasury is going to appreciate it. And so I think this is going to be a really difficult company to ignore, and I'm honestly pretty bullish on Jack's initiative there. There's a lot to be said about the Tether situation and Electron with Swan and all that. I don't know all the details, but yeah, you take a look at companies of that magnitude, and it's hard to be bearish on them.
Yeah, for sure. Quentin, I'll throw it over to you. What's your take on, Maller's kind of announcement and breakdown for this Bitcoin conglomerate that they're building over there?
I don't have a lot of thoughts on 21 to be honest. I don't follow it that much, but on Bitcoin treasury companies overall and what I expect in the next few years is, it's true we'll have a few winners, big companies, but what I expect is that this iPhone moment that is clearly here with STRC, and we're also seeing SATA being super successful with this stable price and variable dividend. It has more volume than all of the other prefs of Strategy combined, except STRC, right? So it's clearly a winner product, and this needs to roll out to all the major capital markets. And we'll need to have an STRC product for all the major fiat currencies in the world. So in Japan, in Britain, in the Eurozone, in China potentially, right? So I think there will be companies that offer those products, and it will be interesting to see who the winner is for each geography. That's what I'm looking for. I think MetaPlanet is the clear front runner in Japan, and then in Europe it's a bit unclear currently.
If I can piggyback on Quentin, because obviously on our podcast we have a lot of guests from different Bitcoin treasuries, and we also obviously have a more of a European perspective because that's where we're based, right? And it's quite interesting to see the dynamics here in Europe because of all the currencies that we have, but it's still strong markets in a way. So you have these different Bitcoin treasuries that are now adapting to the jurisdictions here in Europe. So you see, for example, an H100, who are basically making a sort of alliance between different Bitcoin treasuries with some merger acquisitions as well here in Switzerland, for example. So and obviously their goal is also digital credit when you start thinking about it, because for digital credit you need scale, and obviously they're aiming towards that. So that's one thing. Maybe not all Bitcoin treasuries. We have other flywheels that are also very interesting that we have seen. For example, you have XE in the UK that have also a very interesting flywheel. Obviously, it's not going to be probably as big as digital credit, but it's still going to be very accretive to the company in a Bitcoin way. So that's going to be interesting to see, and how they're at the end they're not competitors to begin with, but you will have different strategies that will come up through this acquisition of Bitcoin, right, in the different jurisdictions. And maybe the last thought here is exactly, so digital credit is obviously the big thing, but there are various ways of doing it. And maybe one last thought before I drop off, because it's late here in Europe. So I just saw an interesting post from Joe Burnett, where you can see Jeff at Risk World, and he's basically alone, and he put it right next to Andreas picture when he was doing his speeches back in 2015, 2016, and nobody's there, right? It's empty. And I'm thinking, wow, it's exactly the same as Bitcoin back in 2016, except now you're looking at digital credit, right? And when you start thinking of that, back then, it took around just under 5 years for Bitcoin to reach the 8 billion market cap. And we've seen Stretch do that now in less than a year. So and all of this, will flow into Bitcoin. So you can't help just be bullish, right? So I'll probably just leave that with my last thoughts.
I love it.
And
I love it.
thanks for having me on, Tyler, and everybody else.
Thanks, One Chair Boys, for jumping in. And Cris, I'll throw this over to you. We've seen strategies up almost 45, 50% nearly on the month. Obviously strategy is kind of like an amplified Bitcoin return. If you're an investor in the company, they're going to likely outperform Bitcoin to the upside and have greater losses on the downside when Bitcoin's price is down. Do you think that's what's behind a lot of these gains? Do you attribute the gain in strategy stock over the last month to the way they've been able to accumulate so much stretch? What are your thoughts on what's behind this move upward?
Yeah, it's I think part of it is this lag of understanding of what stretch is, and then the amplification, or in other words, how much Bitcoin they're going to be able to buy and how fast they will be able to. And as we know, you were just talking about the ETF earlier. I just go back to 2023 when Eric Balchunas and James was on a podcast. I forgot which podcast. And they were lining up all the layers of will the ETF be approved and all that in Q4 in October. And it was like 28, Bitcoin was like 28K. It was like dead. Like the market wasn't front running the ETF. And here's James, here's the Bloomberg guys basically saying everything's lining up for the ETF to be approved here in a few months. And the market didn't care. It did not care at all because it was in a sideways chop, unemotional, no one cares, non-momentum situation, right? Like it makes absolutely no sense. Sometimes the market makes no sense with price action within a weeks, months, sometimes quarters. So, I mean, the equity went from 200 to 100 in a month. Did it get chopped in half? Was it a fundamental reason? Of course not, right? That's what Wall Street is. It's speculation in the short term. And if you get caught off guard, you get absolutely crushed. If you're levered, things like that, the options market, derivatives, like Michael was talking about earlier, when you add those, there's 6 or 7 layers of games being played on top of the equity. Because Michael mentioned just several of those. There's a lot of games and a lot of players. Like in a poker room, you've got 9 poker tables. You're playing poker, but there's 9 separate games. So there's 9 separate games being played on top of the equity. And I promise you, you don't know all the players playing. There's a lot of questions and a lot of things going on that you don't have a clue on, right? So in the sense, did it make sense? It went from 200 to 100. Of course, it didn't make any fundamental sense, right? Did the company do something dumb to make it 50% less valuable? No, we had a lot of macro issues, a lot of people off sides, and a lot of delta hedging and things like that, right? But in the end, if you have a 5-year outlook, none of that even matters to you, right? So everybody has a different way of playing their own game on top of the equity. So, and again, it's amplified Bitcoin. What's the vol on on MSTR recently? It's like 70, 60 or 70, something like that. Like,
yep.
Yeah, people can't deal with 40 vol. Bitcoin's too volatile. Well, how about a 70 vol? Let me give you 100 vol back to 2024. Most people can't touch this stuff, and they're not professionals. And I'm not talking down to people or like that. That's not what this is. It's just a 100 vol asset. There's not a lot of people in the world that can deal with that in the very short term. And you have to have strategies, and you have to be emotionally attached to what's going on because things can change very fast. Because they hit 104 a couple months ago, guys. It's 104 at wick down there. So just how about things change very fast, right? And I do think part of it was people got caught off sides, obviously, and people were the whole it's like 2022 again to me. It was like, oh, they're going to get liquidated again. I'm like, what is this, 2022 again? History tends to rhyme, right? And it was just like 2022 all over again. It was like the same thing. But if you've been in markets for a decade or 5 years or at least a couple cycles, it all sounds the same. Like the verbs are the same. and like, it's below the cost average, it's over, and right, and then you saw just, I mean, the equity just absolutely tank. But if you knew that had nothing, the cost average doesn't mean anything, right? But narrative short term can drive action more than you can understand. So that's probably my biggest thing I would say the last couple months.
Yeah, when you're thinking about like either clients or people you talk to in your derivative circles, Michael, you know, are there people who are looking for like or using MSTR in any sort of hedging strategies, or is it too like is it too I guess not tethered to Bitcoin to be useful in derivative strategies like that?
It would more or less be the other way around, using Bitcoin to hedge your strategy position. I think would be the way that would be dealt. But no, MicroStrategy is not like top of my list as a hedge instrument. It's more an alpha producing instrument, more alpha related, more yield related, if anything, than a hedge. For a hedge, I would default to just simple, basic futures, perps, options, and keep it simple. But yeah, Cris brings up some great points, and that is the poker game happening in any capital market, especially digital assets. Digital assets is a game of liquidity. It's a game of short-term leverage. It's a game of comparing the narrative to the flows and positioning, and knowing that. It's about understanding where the gamma lies, like where the open interest in the long gamma versus short gamma is, and understanding the width of that band when volatility occurs. And that's when you see price action start to pin to certain strikes and muscle moving. Look what Jump did a few months ago. They were systematically selling Bitcoin and then buying it, and they were using muscle to do it. I mean, that's age-old strategy. And they, I think they were asked to stop doing it, so they did. So super interesting stuff. I mean, but those games are played all the time. And typically implied vol levels are going to reflect some of those games. But it's super interesting, and that's the kind of information I'm always trying to gather and garner with my counterparties and my liquidity providers. Exactly what's happening. So I always like to know flows and positioning and compare that to the narrative.
Yep, absolutely. Halston, I'm going to throw it over to you. I'm looking here at the earnings report that we've got. I finally found it. The guys were ahead of me here, but I just want to get that up on the screen. First quarter results, and it's no news to us who are following strategy closely. Of course, we know they're almost at 820,000 Bitcoin. They've got 22% growth year to date, 9.4% Bitcoin yield, and this is kind of the crucial number that I've kind of focused in on is almost $12 billion raised year to date. Last year I think it was $23 billion they raised to buy Bitcoin, and some 20 million the year before. It looks like, if things continue on the back half of this year, they're going to raise another, 25, $30 billion, if Stretch keeps performing. Are these numbers shocking to you now, or are you just, are we just kind of numb that this is an accepted thing? Strategy is going to raise 25 billion dollars, and the sky's the limit here.
Yeah, I'm definitely still shocked by this. I mean, especially because I come from a, more traditional background. I only got into Bitcoin after college and after some time, a little bit of time in the, normie world. And so I think, yeah, this is still very much like it's not that it's getting numb. It's like, I'm not surprised, but these numbers are astronomically they're just ridiculous. And so, yeah, I think what shocks me the most is like, everyone here in the chat right now will look at this and we'll be just appalled by these numbers. Not appalled, but like just shocked. And you'll talk to somebody who literally works on Wall Street, at least I do all the time, people in their late 20s working at top investment banks in other firms and just be completely oblivious to what's going on and completely clueless. And so I think that's more shocking to me than seeing this number. But yeah, definitely, still love to see these numbers, love to see the growth. And yeah, I think it's crazy what they've been able to achieve. I really don't think that anybody can replicate this, at least to this caliber. And so, yeah, excited to hop on this call here in a few minutes and see what they announce and share. It looks like they've been teasing some things. I got to interview Fong Lee at Strategy or at Bitcoin Vegas, and he was definitely teasing some things. And so, really, really looking forward to this call.
Yeah.
But yeah,
Where
no,
can people
I
catch
think
that
to answer your
interview,
question,
Halston?
like I'm not. I think it should be coming out probably this week. I mean, we did it live with the Daily Stack, but we, recorded it as well, and so there'll be clips coming out. A solid 20, 25 minutes with Fong Lee. Same thing with Jeff. He teased. I interviewed Jeff Wilton as well, and he teased quite a few things. So definitely, we got to publish that soon. But yeah, to answer your question, like I'm not known to these numbers. I'm still shocked, but I'm more shocked that Wall Street and the more TradFi people are not really paying attention to these things.
Yeah, what's it going to take, Tim, for TradFi to come in? We've been waiting. We've been talking about strategy for years now, or investing in it, and kind of seeing, being like, oh, that's really awesome. At the beginning, it was kind of like, wow, cool. A company's buying Bitcoin at scale, and yeah, I didn't expect strategy to be able to do what it has so fast. But what's going to be the unlock for traditional finance? When are they going to, really have to be forced to pay attention to this?
I think it's something that Saylor talks about all the time, which is it's a matter of liquidity. So as Bitcoin becomes a bigger asset, as Stretch becomes a bigger asset, I think that's you just sprinkle in a little bit of time, and obviously not, short or medium term, but all along the path. I think liquidity and seasoning, right? They like to use that word. Honestly, it just makes me hungry. But Chris was talking earlier about like where's all of this going, and it just made me think about, okay, well, look at the flip side of that. The best way to figure out what something's going to do is based on what it's historically done. Well, nobody knows about Stretch right now, like practically. I don't know how many people are that you run into in daily life are just like scrolling Twitter all day, but basically no one knows about it, yet it's raised billions of dollars. Where did those billions come from? So it's yeah, I think this is like maybe it's not early to retail adoption, but it's definitely early to the corporates, to Wall Street, to everything that we're really talking about with digital credit and then digital money. I I think I mentioned this to you on our prep call earlier, Tyler. Like I think one of the most bullish things for this next cycle, cycles are over, we're so back, whatever, is build on top of Stretch, build on top of digital credit with these digital money products, whether it's 8% or 80%. And some of them are going to do things that we can't even imagine. And some of them are probably going to blow up. And maybe that's the news cycle. And it's all good for Bitcoin. So very exciting, very exciting times.
Yeah, really exciting times. Quentin, it's nothing in Bitcoin ever happens the way we expect it to, and this is just to see what Saylor's been able to do in capital markets and kind of just like pour all this money. Like Tim said, where's the money coming from? But to see Saylor be able to attack the markets in this way, we've got Metaplanet, we've got companies all across the world, raising money in their markets to purchase Bitcoin. Do you think this is going to continue to be the dominant kind of story in Bitcoin as we move forward? Are these companies like a backdoor orange pill to Bitcoin? Obviously, Saylor's going to quote unquote convert people to buying spot Bitcoin, but do you just see it becoming more institutionalized and the ETFs and Bitcoin treasuries in especially strategy become the dominant vehicle for Bitcoin exposure?
I think so. I think so, and I think that's also what strategy is focusing on. I think Michael explained it in the last few months quite a few times, right? That it's a lot more difficult to explain Bitcoin to someone than to explain Stretch, where you just buy it, it stays at the same price, and you get 11% a year, right? That's pretty simple, and it's backed by Bitcoin. So yeah, I think it is the vehicle that will deliver more Bitcoin adoption, because not everyone in the world will be doing the work to understand Bitcoin. But Stretch is very easy to understand.
Yeah.
And I think this they're at a run rate of around 30 to 36 billion to raise for this year, right? And this is, yeah, it's mind blowing, especially thinking that early in the year, on January 1st, Bitcoin was at 94K. So they were able to raise 12 billion in a bear market, in a down market, year to date. So I don't know what happens when things turn around and we're officially back in a bull market. It's yeah, it'll be crazy to see.
Right. Yeah, it is going to be crazy. Do you think Stretch continues to perform, Chris, in a bull market in this way, or is this kind of like, is the money that's flowed in kind of like a one-time thing as Stretch is, maybe not a one-time thing, but has this been a blip the first 2 quarters of the year, or do you just see this grinding upwards in size, regardless of Bitcoin's price movements?
I think it's more of a grind. I mean, we saw the first kind of corporate balance sheet movement, which I think has been very underappreciated. In strategy world about 6 weeks ago, Prevalent Energy basically coming out and being very upfront, saying we put money in Stretch and we're looking at some point being 9 figures worth of Stretch and coming right out, and that was pretty shocking to me. Like that was, I mean, I knew that was inevitable at some point, but there was companies that got their boards involved and made the decision to take T-bills that are 4%, and there's a 7.5% delta, and they just couldn't not do it. I mean, and you have to get, the problem is you have to get through a lot of mandates, you have to get through a lot of boards, you have to get through so many decision makers in Wall Street or in a corporation, and that's the biggest hangup, and that will continue to be the biggest hangup on this. And I know we say it a lot, but that there's just too many layers of decisions to be made for capital to be allocated to STRC. And again, it's the time that needs to peel off over the next couple of years. And again, so each one of the layers is, once it's rated, guys, once these things are rated, that's what I'm excited about. But it might be a year, it might be 2 years, and that capital will just have to wait. That capital would just have to get 4% when monetary debasement or destruction's 8. You're going to be -4. You're going to be -4 until it's rated, right? Until your corporation, your entity, your family office, and your board decides, well, it's safe enough now. But then your opportunity cost is that you're -4% until you can, right? Now, I know, look, and another thing too to mention is interest rates what if interest rates come down? Guys, if interest rates come down, this product will go screaming as well. And now the interest rate of STRC will probably come down. That's based on the team and what their feel is for the market. How much do they want to bring the rate down from 11.5? If SOFR goes from 4 to 2, do they go from 11.5 to 9.5? What's the model they're going to run on that? That's going to be very interesting to see when the interest rate market changes and how STRC will fluctuate with that. Who knows? That's going to be something that the management's going to figure out, and I can't wait to see their decision on that. Like if SOFR goes to 2 and then they just kind of lag and wait a little bit, like, oh, we'll just keep it up here, and then the delta's 900 basis points and it gets wider, right? At some point you can't ignore it anymore. But it's got to be seasoned enough for funds, especially like hedge funds, to be able to tap their prime broker to then run their own carry trade. It's just too young to do something like that right now. So
yeah, I think the ever increasing size is just going to bring in more of that opportunity, and that just helps liquidity, right? When there's more people making a trade, like you said, this is an easier sell to the boardroom. You know, if you're interested in Bitcoin, maybe you're an executive at a company who's, you know, invested in Bitcoin, and but you've got to sell, you know, to your maybe it's probably the more nimble companies, of course, that are going to allocate to something like Stretch. But you know, it's like, hey, how can we get some Bitcoin exposure on this balance sheet while managing some risk? And you kind of outsource that risk to strategy. Yeah, I just seeing where this is going. Yeah, the institutional demand, the demand from, you know, people seeking yield, you know, family offices allocating, you know, single digit percentages to this type of thing, that adds up over time, right? You've got the DeFi projects, you got Apex, Saturn, all those projects. Like, it's just, you know, lots of pools of capital are going to be rotating in. All, you know, when Bitcoin's price is up, you know, stablecoin volumes surge, and you know, some people who are rotating into the crypto space are going to find, you know, walk into Apex and say, oh wow, yeah, I'm going to try this yield strategy, see if I can lever up and get 20-30%. And you know, some people might get wrecked, but some people might be able to do some really crazy returns, you know, just backed by Stretch, you know, in some really creative ways. We're just a couple minutes from the call here, guys. Does anyone have a parting thought or something they're really looking forward to? Something we didn't touch on that you want to hit on? If not, I'll go around the horn and kind of say our farewells.
If I could throw something out there real quick, we were talking about, you know, people that's been going around, like, you know, banks white labeling STRC and stripping the 11.5 down to 7 and giving 7% to depositors. Saylor's obviously talked about that. Digital money layer for several months, ever since December in the Miami Economic Forum, I believe, podcast about 4 months ago. That's something that that's another kind of duration thing. It's gonna take time. But instead of saying white labeling, I want to throw out orange labeling, because white labeling is kind of a default. So let's call it orange labeling. I'm calling myself out too. But you know, to see the banks orange label STRC and then strip it from 11.5 to 7, and then have that competitive advantage as a bank to give your depositors 7% with zero vol, is an idea and a concept that it just, again, it sounds way too good to be true. That's the issue. I mean, that's the issue. But once it's done, and once they get past the regulation part of this, the regulatory aspect of being able to do something like that with the product, and it actually pays out, right? That's when that momentum will happen. And I've mentioned it too. It's like, you know, Wall Street is just like the NFL. It's very much a copycat league. And if one bank does this and it works and they operate at a high level, what do you think the other banks are going to do? This is not hard, right? So it's just going to get past that first step of regulatory.
Great stuff. And
Chris,
where
that's
can
really
people...
interesting.
Yeah. Go ahead, Halston.
I was just going to say, just on that, like, what do you think it takes? I'm thinking just like psychologically to the masses, like, what do you think it takes for those people to not think that it's too good to be true?
The users, depositors, you mean? Mm-hmm. Like people? Oh, I mean, that's a great question. My story is, my uncle never wanted Bitcoin. I tried to tell him about Bitcoin. He didn't want to hear about it. But then I talked to him about Stretch, and he bought Stretch. He opened a brokerage account for the first time in his life.
Wow.
And bought Stretch in August. He bought Stretch in August, and he was in a Chase checking account. And I said, hey, there's this thing. It pays you 9%, and like he had an Apple savings account with the Apple Card. It was got like 4. Oh, but here it is, guys. The rate went down on some of these, on the Apple Card product to 3.75, and it triggered him. This is what's interesting. He's like, it's paying 3.5. It went down. I'm like, yeah, they're going to be going down, right? So I told him, hey, there's this thing paying 9%, and I explained it to him, and he opened up a brokerage at Schwab, bought STRC at 97. So he got the 97 to 100 delta. So he got $3 of that. Plus he collected dividends along the way. And he had never touched a product like this before. There's no way he would ever touch a preferred stock. So anyway, I think it's a relationship thing, of course, like with wealth managers too, like in that business, like it's, do you trust the person you're speaking with? Yeah. Do they understand the product enough, right? So.
Yeah, good stuff. I'm going to go around the horn, and thanks for joining, guys. And just tell everyone where they can follow you online. Quentin, I'll start with you.
Quentin is on X, and One Share Podcast on YouTube and on X.
Great stuff. Tim?
Yeah, Tyler, thanks for having all of us. I'm going to be heading over to Madrid for the Mad Bitcoin Summit next Monday and Tuesday. So if you're in that part of the world, or you just like to have a good time, come to Madrid. And then at the end of the month, Ed and I will be participating in the Bitcoin Treasuries Unconference UK in Bristol. So again, if you're in that neck of the woods, would love to see you in person. And you can find me on X at Tim Kotzman.
Awesome, and those events are always class and high quality. Tim, I'll throw it over to you, Halston.
Yeah, you can find me on X just at Halston Valencia. I'll also be at plenty of conferences this year. Bitcoin is for everyone coming up here at the end of the month in Portland, and I'll be at the True North event. Yeah.
Cool, Chris.
Yeah, it's at Cris Reed on X. And I invite, if somebody wants to come on the podcast, feel free to reach out. DMs are open, especially talking about kind of bridging STRC to Wall Street.
Good stuff. And Michael, I'll give you the last word.
Sure. LinkedIn is my preferred social media platform. It's my name as it appears. You'll find me. You'll see my picture. Please connect anytime. I love to talk digital assets and the vol space.
Great stuff. Thank you so much to all of you who joined. Again, I'm Tyler Rowe with BitcoinTreasuries.net at Tyler Compiler. We'll debrief later, guys. I'm going to keep the stream up, and we'll be simulcasting the MSTR earnings call, so stay strapped in. Thank you to everybody who joined in the comments. Van says he doesn't think they're going to pay 11% in a bull market. I think you might be right, Van. John Bescherer says, thanks, guys. Shout out to everybody who's followed, and stay strapped in here for the MSTR earnings call.
See you guys.
Thanks, guys. Thanks, Tyler.
Thanks. Thanks again, everybody, for joining. It's just going to be one moment here while we get the stream up and running.
May 2026, roughly 3.9% of total circulating supply, underscoring its bold Bitcoin acquisition strategy as the core driver alongside the transition of its enterprise software business toward a cloud-native platform. But look, I've got to be straight with you right from the start. The earnings discussion and highlights are going exactly into why we're all here focused on sound money, financial sovereignty, and accelerating Bitcoin and crypto adoption. This isn't a distraction. This is actually a perfect opportunity to celebrate the spirit of Strategies Q. One results in a unique way by pairing it with real on-chain action that accelerates the very mass adoption we've been talking about. Strategies Q1 2026 results represent the leading edge of corporate Bitcoin strategy, with disciplined capital allocation and long-term vision at its core. It's the earnings call where Bitcoin treasury updates and enterprise software progress are proving once again that bold execution can deliver real value while pushing the boundaries of what's possible with decentralized assets. That same spirit of rethinking capital allocation, settlement systems, and monetary policy is exactly what this live demonstration embodies. To properly mark this special moment during Strategies Q1 2026 earnings call, and to celebrate the shared vision of a Bitcoin standard future while we connect and collaborate, Strategy
Q1 financial results. We reported an operating loss of $14.5 billion and a net loss of $12.8 billion. As you would expect, these results were primarily driven by the decline in Bitcoin's fair value during the quarter. And as these are largely non-cash market-driven impacts tied to Bitcoin's quarter-end price, our underlying strategy remains unchanged. Raise capital responsibly, buy and hold Bitcoin over the long term, and grow Bitcoin per share for our shareholders. On slide 8 here, Bitcoin per share increased from 181,030 sats per share in May 2025 to 213,371 sats per share in May 2026, which is roughly an 18% year-over-year increase. Year to date, we have delivered 9.4% BTC yield compared to 22.8% for the full year 2025, showing acceleration year to date compared to the same point last year. We've also generated 63,410 BTC gain so far in 2026 compared with 101,873 BTC for all of 2025, having already achieved about 62% of last year's full BTC gain in just the first 4 months of the year. In dollar terms, that represents approximately $5 billion of BTC dollar gain year to date versus $8.9 billion for the full year 2025. Since 2020, Bitcoin per share has grown to 213,371 sats per share as of May 2026, which is nearly a 4x increase since the beginning, delivering positive BTC yield every year across multiple market environments. In 2025, we delivered 22.8% BTC yield, and so far in 26, we've already added another 9.4%. We remain focused on consistently increasing Bitcoin per share over time through our disciplined treasury operations and long-term conviction in Bitcoin. Here on slide 11, our track record remains constant, having acquired additional Bitcoin in every quarter since 2020 across 108 separate acquisitions. As of May 4th, we held over 818,000 Bitcoin for a total value of approximately $64 billion and a total acquisition cost of about $62 billion. Our average purchase price is approximately $76,000 per Bitcoin, and our holdings now represent, as I mentioned, 3.9% of all the Bitcoin that will ever exist. Turning here to the balance sheet, digital assets ended the quarter at $51.6 billion compared to $58.9 billion at year end. Having acquired 89,599 Bitcoin in Q1, the change reflects the lower price of Bitcoin at the end of the quarter versus at the end of last year. Cash and cash equivalents were $2.2 billion, which largely reflects our USD cash reserve. Regarding taxes, the change this quarter was driven by the quarter end mark-to-market movement in Bitcoin. And as Bitcoin moved from an unrealized gain at the year end to an unrealized loss at the end of Q1, our deferred tax liability of $1.9 billion shifted to a deferred tax asset. A full valuation allowance against that tax asset brought the net balance sheet tax position to zero, which also resulted in a non-cash tax benefit on the income statement, which partially offset the pre-tax loss for Q1. Long-term debt remained unchanged at $8.2 billion, while preferred equity increased to $9 billion, driven by strong stretch issuance in the quarter. Overall, the balance sheet remains highly liquid and extremely well capitalized. At the end of Q4, the market value of our Bitcoin was approximately $59 billion, which is based on a Bitcoin price of about $87,500. During Q1, we recognized that unrealized fair value loss of about $14.5 billion. And despite Bitcoin price volatility, we continued to execute, having purchased an additional 89,599 Bitcoin in the quarter for approximately $7.3 billion at an average price of about $80,900. We ended the quarter with a digital asset value of $51.6 billion based on a Q1 ending Bitcoin price of about $67,800. In Q2 so far, we are illustrating an unrealized fair value gain of approximately $8.3 billion as of May 1st. We purchased an additional 56,235 Bitcoin quarter to date for approximately $4.1 billion at an average price of roughly $73,400 for that period. Those purchases benefiting from the increase in Bitcoin price adds approximately $300 million of positive fair value. And as of May 1st, our Bitcoin held a market value of approximately $64 billion based on a Bitcoin price of $78,350. $1 billion Bitcoin reserve, implying an MNAV of 1.27, which has expanded since the beginning of the year. We have $13.5 billion of preferred equity, representing 34% amplification and net leverage of 9%, made up of the $8.2 billion of convertible debt. Strategy is building around Bitcoin as digital capital. We have approximately $58 billion of equity. You can see here, large traditional banks operate with liabilities to asset ratios above 90%. Our ratio is a mere 9%. That gives us a very different foundation made up of a very large equity base, substantial Bitcoin reserves, and structurally lower balance sheet risk. We can issue Bitcoin-backed credit products to support investors with strong collateral and continue accumulating Bitcoin over the long term from a position of strength and durability. We have approximately $6 billion of net debt, which represents just 9.3% net leverage against our Bitcoin reserve, which is effectively a 10.8 times BTC rating. Our strategy is based on a disciplined balance sheet construction, modest leverage, strong collateral, and permanent capital to grow our Bitcoin over time. Our net leverage is lower than the average of the investment-grade S&P universe and lower than every major industry sector across most S&P 500 companies. At the current Bitcoin price, our Bitcoin reserve is valued at approximately $64 billion compared to $6 billion of net debt, which translates to the 10.8 times BTC rating. The stress case on the right shows that even after a 91% Bitcoin price decline to roughly about $7,300 per Bitcoin, our Bitcoin reserve would still be sufficient to cover our net debt at a 1 times BTC rating. Our USD cash reserve has remained consistent at $2.25 billion. And while the years of coverage has shifted down with the growth of Stretch this year, we believe the stable cash, along with our Bitcoin reserves and ability to raise additional capital, continues to provide us with the flexibility to continue supporting our dividends for the foreseeable future. On the next slide, the $64 billion of BTC reserves adds an additional 43 years of coverage. Another way to look at this, at today's reserve size, Bitcoin would need to grow by only 2.3% annually for the reserve growth to cover our current obligations. If Bitcoin grows at or faster than the break-even ARR here, the BTC reserve alone can support our dividends without requiring any additional capital. Before I turn it over to Phong for his remarks, I'd like to highlight the amendment to Stretch that we have asked for your vote on. We are proposing to move Stretch dividends from monthly to semi-monthly, with payments twice per month on the 15th and the last day of the month, while keeping the economics unchanged. Our goal is to make Stretch work better for investors by reducing reinvestment lag, improving liquidity, dampening the impact of a single monthly record date, and helping Stretch trade more efficiently around the target price. Today, Stretch pays out 12 times per year with one payment at month end. Under the proposed amendment, Stretch would pay 24 times a year with payments around the 15th and the last day of the month. Again, total dividend economics are unchanged and payments would simply be about half the size and paid twice as often. Under the proposed change, there would be two record dates, one on the 15th and one at the end of the month, with the related payment dates made on the next scheduled record date. If the vote is approved, the first record date would be June 30th, and the first payment date would be July 15th. The mechanics are pretty straightforward: same dividend economics, more frequent payments, and a clear transition timeline. We believe this change creates the highest frequency credit instrument in the world and makes a great product twice as better. And we look forward to your support. With that, I will turn it over to Phong.
Thank you, Andrew. Thank you, everyone, for joining us on this evening's earnings call. I have a few updates to make on our capital markets, on our equity, on our digital credit, and then I'll conclude with updates on our capital market strategy overall. You know, if you had asked us at the beginning of the year, what was our target for the year in terms of capital markets raises, we would have said it was uncertain, and it really depended on the success of the stretch product. And I think 4 months in, we can say that stretch has been more successful than we had expected at the beginning of the year. And one representation of that is the amount of capital that we've been able to raise for the company and ultimately for Bitcoin. And you'll see here, year to date 2026, we've raised $11.7 billion, as Andrew had mentioned, notably about half from issuances of our common equity, half from issuances of our preferred, primarily stretch, and no longer are we issuing convertible debt to raise capital. How does that compare to the rest of the US capital markets, equity capital markets? You'll see last year we represented about 8% of the equity capital markets. In the full year 2025, we were the largest issuer, and we are again this year the largest issuer in the equity capital markets, about 10% total, 6% of common equity, and 60% notably of preferred equity. And we're doing what we said we would do and what we were trying to do, which was to shift our ATM more towards credit. And you see this even pronounced as we look at each month of the year 2026. We started in January with 20% of our equity issuances using digital credit, 88% using MSTR, and we've largely flipped that number in April, with 17 using MSTR and 83% using digital credit, which of course is also less dilutive to our overall shareholders. Research analysts have been consistently supportive as we look to exit the Bitcoin bear cycle that we're in. The average price target of all of the equity analysts covering strategy for Bitcoin is $138,000, which is about a 70% increase. The average MSTR price target is about $323, which is an 80% increase from current levels. So let's talk about digital equity and MSTR overall. We show this chart every quarter. You can find it on our website, strategy.com. But this is our annualized asset performance since we adopted the Bitcoin standard. August 10th of 2020 is when we look back to. We've outperformed Bitcoin by about 50%. Bitcoin has outperformed the Mag 7 by about 50%. And the Mag 7 has outperformed the S&P 500. So our ultimate objective is for our common to outperform Bitcoin by accreting Bitcoin per share. And based on this chart, we've continued to deliver on that performance. As Andrew mentioned, our Bitcoin per share is also accreting. That's our business objective ultimately. And we're at 9.4% Bitcoin per share increase so far this year. And you'll see that's also accelerated in the last month, right? We started off a little bit slow in January and February, 0.4 and 0.1% increase in the month of March with 3%, and really increased, doubled in the month of April with 6%. Last quarter on this call, we said our objective is to double Bitcoin per share in 7 years. Doubling Bitcoin per share in 7 years implies about a 10% annualized BTC yield. And as I mentioned, so far this year, we've increased 9.4% our BTC yield. So we're well onto our annual target, and we've been happy with the success of Stretch so far this year. And ultimately, MSTR continues to be one of the most widely held equities around the world and the most widely held Bitcoin proxy in the world. And we're able to reach 1,400 institutions, 927,000 retail accounts, 1,300 ETFs and funds, over 100 million beneficiaries that share nearly 4% of the Bitcoin in the world. So I don't think about this as concentrated amongst one company, a set of leaders, but really amongst 100 million people that we're sharing Bitcoin with per share around the world. So let's talk about digital credit, our favorite topic so far this year. Look, the idea of preferred capital and preferred credit is not a new idea. In fact, the Industrial Revolution was built on the railroads, which was built on digital credit. built on analog credit through preferred capital. At that point in time, during the late 1800s and early 1900s, 20 to 40% of the capital structure around the world was preferred capital. What happened in the mid 1900s and the early 2000s is the rise of liquid debt markets, increased regulation, pushing preferred capital into what I would call niche use. Now, as people are waking up to preferred capital and digital credit, especially, we're seeing a reemergence. And my analogy here is where preferred capital helped build the railroads, which helped drive the industrial revolution. Now, digital credit will help drive the digital railroads or the digital rails. It will drive the digital revolution, including the AI revolution. So we're excited about bringing this back to the forefront of the world. If you look at an overview here, we have 5 preferreds. We've mostly been focused on Stretch so far this year. I think there's an opportunity for the remaining preferreds to start to perform as Bitcoin starts to perform. But Stretch is clearly the tip of the arrow as far as digital credit. And so that's what I'll talk about primarily. We're up to 11.5% dividend yield. Notably, we've kept this flat for the last 2 months, right? So we've increased the dividend yield from 9% to 11.5%. And now we're flat for the last 2 months because what we've seen is the volatility has started to decrease. The price has started to remain stable. And we've seen an increase in Sharpe ratio, 2.53. So the notional value is up to $8.5 billion, and we're trading $375 million a day. And I'll share how that compares to other preferred equities and also common equities in general. The first thing I'll note is the rapid growth of Stretch. Right? In just 9 months, we've raised $8.5 billion of capital. We had a running start with $2.8 billion. It slowed down and it's really accelerated over the course of the last couple of months. Comparatively, this is one of the most successful financial instruments ever created in terms of capital inflows. It's second only to IBIT. Compared to other products, it has seen faster growth in terms of capital inflows than famous products like the iPhone or Google AdWords. So we're very proud of the acceleration of the product, and it means that we built something that is resonating with people in the US and people around the world. Stretch is by far the largest tradable preferred in the world. Right? We're nearly 2 times the size of Wells Fargo's preferred. And you'll see here what's interesting is almost all of these other preferreds, save us and another one, are bank preferreds. So this has gone from being an industrialized product that's building the industrial revolution to a niche financial product. And we're excited to bring it back to being a major product in the world. The liquidity of Stretch, so this is the average 30-day average trading volume, is 25x the second largest preferred. So where Wells Fargo is about half our size, is trading 1/25th of what we're trading at $15 million versus $375 million. And what that means is with that liquidity, the turnover of the next best preferred, we're at 4.4%. 10x of what Wells Fargo is and some of these other products like Bank of America products. So we think we really found a new product category, digital credit, based on an old product category, preferred capital, and we're excited about where this is going. Interestingly, and as we pointed out before, Stretch is performing not just as one would expect in a bull market, but performing in a Bitcoin bear market. So while Bitcoin has gone down 37% since the beginning of October, now it's starting to rise again. We're seeing Stretch trade essentially near par and paying dividends that are increasing in a monthly. So we've increased the dividend, as I mentioned, from 9% to 11.5% and kept it steady at 11.5% for 2 months, now going on 3 months, while Bitcoin has been decreasing. And so with that, we've also seen the ATM velocity of Stretch has accelerated. And the ATM velocity is really the net inflows into the product, right? This is the demand of the product overall. And you'll see notably in April, we had a week where we raised $1 billion. And then the subsequent week, we raised $2.2 billion. And so we've seen tremendous demand coming into stretch. And at the same time, we're seeing the volatility decrease. And so our target price range for stretch is $99 to $101. We've actually seen it trading in a much tighter range. And for the last 3 months, March, April, May, it sat in that price range for 100% of the time. I mentioned here the daily liquidity is pretty significant, but it's also growing, right? So from $54 million to $120 in January to $250 in March to $360 in April. So for those who are interested in getting into the product and size, if you're a corporate or if you're a large institution and you need to have confidence that when you need to trade in and out, you need liquidity, our product is showing that level of liquidity. I'll go through a series of analyses of Sharpe ratio, because Sharpe ratio ultimately is a measure of the returns above the risk-free rate given the volatility of the instrument. And ultimately, if you're an investor, people are looking for high Sharpe ratios. Right? So compared to traditional credit, junk bonds, investment grade bonds, bank preferreds, we outperform pretty notably. Compared to traditional asset classes, the S&P 500, even Bitcoin, NASDAQ, et cetera, we also outperform very notably. And then obviously, if you're looking for Sharpe ratio, a lot of folks go to the Mag 7 equities, right? And NVIDIA is obviously on a hot tear because of the AI trade. Google runs essentially a digital monopoly and has been a very solid equity over the course of the last 20 years. Stretch has outperformed all of those and all of the Mag 7. You know, another place people typically go to find a high Sharpe ratio are hedge funds, right? Hedge funds are built with different strategies, different analyses, different quant strategies, and typically they're built to outperform the S&P 500. And with lower volatility. And here what you'll see is looking at different hedge fund strategies, stretch to date, you know, notably, you know, and understandably early in its maturity is already outperforming these different hedge fund strategies, whether you're a multi-strat, whether you're a macro, equity, arbitrage, et cetera. So we see a lot of benefits to this emerging category of digital credit, right? When compared to hedge funds, private credit, private equity. One is extremely liquid, right? To get these levels of returns and these levels of Sharpe ratios, sometimes people subject themselves to 90-day lockups for hedge funds, 3 to 7 years for private credit, 7 to 10 years for private equity. We charge no fee, right? These other strategies often charge a management fee of 1 to 2% and a 10 to 20% carry, right? A 2 and 20, if you will, right? Digital credit is homogenous. You know exactly what's behind it. It's Bitcoin. These other strategies are sometimes heterogeneous with many different assets grouped together, and making it very hard to ultimately assess the risk. Ours is scalable through an ATM mechanism that allows people to buy the product, and hedge funds and other strategies are discrete. We're accessible, traded via 4-letter ticker on the NASDAQ, and now, interestingly, trading on many tokenized exchanges and tokenized products. The other ones are typically restricted to those who are accredited institutional investors or high net worth individuals. And we're transparent, right? We disclose our performance, our holdings through weekly 8Ks and websites that update every 15 seconds. So one of the big questions as we have seen Stretch perform over the last 4 months, essentially the year 2026, is what does this mean for our capital market strategy, right? And I'll introduce this topic and Michael will talk about it a lot more, right? And so we said our objective is to double Bitcoin per share in 7 years through the success of digital credit. And so what does that mean? We sell digital credit, right? And we've said that we target about 10 to 20% of Bitcoin reserves annually in digital credit volume. And of course, we'll analyze that and assess that to see if that target makes sense, but that will generate amplification to our common stock, right? Which should increase the Bitcoin per share in our common stock, which is ultimately our goal. And as we increase Bitcoin per share, that allows MSTR to outperform Bitcoin, which is what you've seen happen over the last 6 years, right? What what allows us to flex these levers even better if our cost of credit goes down, right? If we're able to decrease the yield from 11.5% to lower for a variety of factors, if we're able to sell more stretch, that increases amplification. And if our MNAV goes higher, and I'll talk a little bit about our MNAV, but that also creates benefits, for example, our cost of paying our dividend. What has happened in the last 4 months is we have increased optionality for strategy of the company, right? We have more sources of capital and we have more uses of capital than we ever had before. And the successive stretch gives us options to do different things from a capital markets and a treasury operations perspective to benefit our common shareholders. Right? Our traditional sources of capital, sell MSTR, sell stretch, right? We could sell our US dollar reserve, right, to pay dividends, which we added in November. We also have Bitcoin that we have the opportunity and the option of selling. We can see our other prefs start to perform and sell those into the market. And we've talked in the past about also being able to potentially sell BTC or Bitcoin derivatives. What are our uses of capital, right? Primarily today, we bought Bitcoin. We use capital to pay our US dollar dividends. And we use capital to build up a US dollar reserve. We have used capital in the past to pay down our convertible debt, our secured loans, our Bitcoin-backed loans. We continue to do that in the future. And then we could also use capital if we want to in the right time to retire any of our other preferreds, right? So what does this really mean? This means we had 3 trades that we have executed. And really, before 2025, 2 trades. We sold MSTR, we bought Bitcoin. We sold MSTR, we bought US dollars. Last year, we added stretch and prefers, and we sold stretch and we bought Bitcoin. Now, we're really seriously thinking about and contemplating and want to introduce the concept of a few more trades, right? Selling MSTR at the right MNAV, whereas Bitcoin per share accreted to buy back debt. What does that mean? Considering retiring potentially early some of our convertible notes using our common stock. Selling stretch to buy US dollars, right? We haven't done that much to date, but perhaps reserving part of our stretch proceeds to build up our US dollar reserve. And then selling stretch to buy back debt, right? You can see how that would be an accretive trade to Bitcoin per share because stretch inherently on sale is not dilutive and buying back future dilutive convertible shares, right? And then the third sort of set of interesting trades that I sort of previewed on the last slide is selling Bitcoin, right? And this is a big sort of statement, but our ability to sell Bitcoin either to buy US dollars or sell Bitcoin to buy debt, if it's accretive to Bitcoin per share, right, is something that we would consider doing going forward. So how do we make these decisions? Ultimately, there are 2 sides of the same coin, if you will. One side is our equity performance, right? And to our common shareholders, the most important thing is to accrete Bitcoin per share, which results in higher BTC yield, which ultimately those together result in a higher BTC gain, right? Adding more Bitcoin and BTC gain on a dollar basis is the closest proxy to earnings per share. So those are the 3 KPIs we look to assess equity performance. On the risk side, right, the other side of the coin, right, we have a BTC rating, which is the amount that our debt and our leverage is over collateralized by Bitcoin. We have an MSTR duration, which is the average duration of all of our instruments, right? And so if you look at our perpetual preferreds, they have the longest duration based on a Macaulay duration basis, 10, 15 years out. And then we have our convertible debt, which has a shorter duration. So swapping longer duration for shorter duration is a good trade for us, right? And then we have MSTR risk, right? And so the BTC rating and the MSTR rating together influence the total risk profile to the company. And so we'll talk through a little bit more about this framework later. A couple of things I want to note before I hand off to Mike. One is Bitcoin per share accretion is our primary goal. MNAV is an input, right? The threshold for Bitcoin per share accretion when selling our equity and buying Bitcoin is increasing over time, right? So where it used to be a 1x MNAV, as we add debt and as we add preferred primarily to our structure, the break even increases. Right now it's about 1.22x. That means at 1.22x or higher MNAV, it's accretive for us to sell MSTR and buy Bitcoin. Below 122x MNAV, it's actually more accretive for us to sell Bitcoin, right, and pay off our dividends than it is above 122x MNAV. And so that's a note, and we'll talk more about this and we'll explain it further. But it's an important point because I think there is a misconception that the break-even point is 1.0x. Next thing I'll note, there are benefits to the way we bought Bitcoin and the holdings of Bitcoin that we have by cost basis tier. And you'll have this here, taking $20,000 tranches, 0 to 20K, 20 to 40, 40 to 60, 68 and beyond. We bought Bitcoin at every price level. Below current price is about 80K. We have an unrealized gain from a tax basis on that Bitcoin. Above 80K, we have unrealized losses. If we were to sell Bitcoin, our objective would be to sell high cost basis Bitcoin to capture some of those unrealized losses and to take some of those unrealized tax benefits, of which on our balance sheet, there's about $2.2 billion, right, estimated of tax benefits. So there is a tax benefit if we were to sell high cost basis Bitcoin as an example, right, to pay down some of our dividends over time. Amplification. We're currently at about 34% amplification. A portion of that, about 10% of that, is driven by our convertible debt. The ability for us to increase amplification to the company is higher when we have long duration digital credit than it is when we have short duration convertible debt. So as the company starts to cycle over time from convertible debt to digital credit, we can take on more amplification with lower risk levels. And so we could see ourselves getting 50, 60% amplification levels over time and still feel like we have a high credit quality and a high risk quality to the company. And the last thing I'll share here before I get to some of our principles is the US dollar reserve, right? We have built up a $2.25 billion US dollar reserve, which at that point represented over 2 years of dividends and interest payments. And now we're with the same exact US dollar reserve at about 1.5 years. Adding to the US dollar reserve reduces Bitcoin per share, but improves the credit quality of the company. And so it's something that we'll continue to evaluate over time, what the right level of US dollar reserve is. We feel like at a minimum, it should be $2.25 billion, but likely as we grow our digital credit and stretch, we will want to add to this at a certain level. So I'll summarize what I shared here because hopefully it addresses a lot of questions from our shareholders. How do we think about managing capital markets and our balance sheet? One, our objective is to create long-term value for MSTR, right? We want to increase Bitcoin per share, which will increase the price of the common equity and ultimately be better for our common shareholders. Two, we're going to continue to grow demand for stretch. We've seen it to be a very popular product in the market and very beneficial to our balance sheet. It will continue to improve the features as we can. For example, moving to semi-monthly dividends. Three, we are going to proactively reduce convertible debt based on market conditions. And that could mean actively purchasing back through whatever means we think appropriate some of the convertible debt before it comes due. Right. Fourth, we're going to look at the stretch demand and credit risk to determine the size of the US dollar reserve. And there's a natural market mechanism that as the US dollar reserve in months to cover, years to cover decreases, the credit risk of stretch goes up nominally and could decrease the demand. And so we will monitor that to decide what is the right US dollar reserve size. Fifth, similarly, the amplification, the appropriate amplification for the company will also base on market conditions. Right? Mike and I and Andrew and the entire team are looking literally every day at what are the trades that are accretive to Bitcoin per share? What are the trades that create the right equity accretion and what are the right trades that manage the credit risk at the right levels. And 6, not necessarily most importantly, but maybe most notable, we will sell Bitcoin when it's advantageous to the company. Right? We're not going to sit back and just say, you know, we'll never sell the Bitcoin. We want to be net aggregators of Bitcoin, increasing our total Bitcoin, but more importantly, increasing our Bitcoin per share, because we think that is what is going to be most accretive long-term for MSTR and for the common. And with that, I will hand it over to Michael Saylor to complete the presentation.
Thank you, Phong. I thought I'd elaborate on some of the things said up till now and just give you an overview of the BTC market and then our capital market strategy. Everything is based on digital capital, and Bitcoin is digital capital, and that means global, legitimate collateral, global property. So we keep track of Bitcoin as digital capital and the consensus in the market. And what you can see here is the US government has embraced it. All of our key financial regulators, the head of Treasury, the head of the SEC, the head of the CFTC, and now the incoming head of the Fed are all digital assets enthusiasts, innovators, and Bitcoin believers, as is the President of the United States, Donald Trump, and the Vice President, J.D. Vance, along with many, many other cabinet members. And I think that's a very important fact. There are a lot of bills still working their way through Congress. The most notable one right now is Clarity. The real key here is that Bitcoin is a priority in the House, in the Senate, on the Hill, at the White House, and there's bipartisan support and bipartisan agreement for Bitcoin as digital capital and for legislation that supports the adoption of Bitcoin as digital capital in the world. Really exciting. A few months ago at our Bitcoin for Corporations conference, we saw major announcements by systemically important banks, Morgan Stanley, Citi, TD, all with intent to integrate Bitcoin into their operations. This is something we only hoped for 3 or 4 years ago, and now it's reality. And at the point that Bitcoin's integrated in the banking system, then it's digital capital here to stay. You can just see the announcements across your ticker, right? Everywhere in the world. This is a global phenomena. It turns out whatever happens in the US and with the US banks is spreading to Europe, to the UAE, to Hong Kong, to South America, etc. I think you're going to see these announcements accelerate, but we've crossed the event horizon. And it's pretty clear that you can't put the genie back in the bottle. Bitcoin has arrived. We try to be systemic, so we track it. And we track the 15 largest or most systemically visible banks in the world. And we look at their embrace of Bitcoin as a creditworthy instrument. Will they trade it? Will they offer credit against it? Will they custody it? Will they handle the derivatives? Etc. And what you can see here is that adoption has actually advanced since even last quarter, and everywhere in the world across all of these banks, there are active efforts to improve Bitcoin support. If you track the number of accounts that support Bitcoin access, you can see we're marching up into the high hundreds of millions. 840 million crypto exchange accounts, nearly 1 billion neobank accounts, nearly 1 billion brokerage accounts that all have access to some sort of Bitcoin derivative. ETFs, of course, continue to embrace Bitcoin. There's now been 125 ETFs with about $126 billion of capital. The capital flowing into these ETFs continues to accelerate. And as you can see, we were the first company to embrace Bitcoin, and now we're up to 194 public companies. We anticipate this will continue to grow. Lots and lots of IPOs. The public markets have embraced Bitcoin, and this is just an example of some of the notable companies that have come public just recently that have substantial Bitcoin exposure. The digital credit ecosystem has been a very pleasant surprise. It has grown very rapidly. And it's become very diverse. And the way that we know that digital credit is working is that companies and economic actors everywhere in the world that we've never met face to face are discovering this, and they're building products and businesses around it. So right now, what we see is very enthusiastic support with retail investors, with corporate treasurers, with institutional investors, with crypto native innovators, and with TradFi innovators. So 5 different groups of capitalists, but they're all getting very heavily involved enthusiastically and rapidly. If we drill into retail, 80% of all STRC shares is held by retail as of our last check. This is an extraordinary fact. Normally, it's very difficult to get broad, deep retail support for a common stock or a public stock. And yet we've been very pleasantly surprised. We're able to trace about 120,000 individual retail accounts. Word of mouth is spreading this. It's spreading virally. Based upon our studies, we see that anybody that buys STRC is generally telling their friends, their family, their parents, their working associates about it, and it continues to spread word of mouth. You can also see Schwab is a big distribution channel. 23% of Stretch is held in Schwab accounts. Fidelity is a channel. Robinhood is a channel. Morgan Stanley and E-Trade channels. BlackRock is a channel. Interestingly enough, Vanguard, that won't let their investors buy Bitcoin natively, they actually are a channel for Stretch. And so it's pretty exciting that we have wrapped Bitcoin into a credit instrument that is being distributed through all sorts of traditional finance channels to types of investors that otherwise would never be able to buy Bitcoin itself or would never want to. We actually have traced Stretch exposure, and we estimate that there are about 3 million households that are benefiting from Stretch right now. So think of it as powering a savings account for 3 million households. Fong mentioned about 100 million beneficiaries of MSTR. Well, 3 million beneficiaries of STRC in 8 months is a pretty good start to the race. Our ambition is to spread this to tens of millions and then hundreds of millions of people. So we're off to a good start, but we're just very enthusiastic about the retail support. We're also very enthusiastic about corporate support. Corporations, unprompted by us, we didn't go and sell this to them. They just figured out that it was a good idea for them. But corporate treasurers and corporate CFOs with working capital have been allocating some of their treasury capital to Stretch. And this is a really pleasant development. And, we're starting to think that there might be thousands of companies that might allocate some amount of their treasury capital to Stretch. And, I've had a lot of experience selling BTC to corporations. What I found is that tends to be a board level decision. It goes all the way to the board of directors. The CEO has to be way behind it. And if one director on the board has concerns, the cycle slows down. But with STRC, it's not a board level decision. It's more like a CFO level decision. If the treasurer is enthusiastic, the CFO can green light it. They might or might not give the CEO a heads up. But this is a very different value proposition. It's maybe a 5-minute conversation with the CEO instead of a 2-hour conversation with the entire board. For that reason, we think that STRC really is Bitcoin for corporations. It's going to spread very rapidly now. The other thing that's very exciting is that STRC has spread into credit indexes. BlackRock's PFF is a $14 billion credit ETF and Stretch is the number 2 holding. VanEck's PFXF is another credit ETF, and Strategies Stretch is also the number 2 holding. And so imagine an instrument coming out of the blue, didn't exist 12 months ago, and in less than 12 months, we've gone from non-existent to number 2. Next stop, number 1. We're enthusiastic about seeing stretch embedded in lots and lots of institutional credit indexes and lots of institutional credit funds. Third-party ETFs have been finding stretch, and they're building innovative ETFs. Strive is building a digital credit ETF. 21 shares created an ETF with stretch and took it public in Europe. There's a number of ETF providers that are working with us that are in the pipeline right now. I think active discussions with 4 right now. And so we would think that over time, there'll be more ETFs that build STRC into their fund offering. So here I'd like to talk about digital money and digital yield. We start with digital capital. Bitcoin is 34 vol on a rolling 30-day average. It's 39 ARR. The 1-year trailing vol of Bitcoin is almost 40. So think of it as a 40 vol, 40 ARR asset, raw economic energy. We split that asset into STRC, which is 3 vol, 11.5% yield, and then MSTR, which is 71 vol, 59% ARR. So one's an amplified Bitcoin we call digital equity, and the other one is damped, digital credit. Now, digital credit, we believe, is like the kerosene of finance, right? It is the monetary fuel, and is a universal monetary fuel. It's high grade, highly distilled, but from here you can build all manner of products. And we see the layer 3 as digital money and digital yield. Neither of them would really be possible without digital credit. It's just too difficult to distill pure 0 vol 8% money from a 40 vol 40 AR asset. You have to crack it. You have to have a crypto reactor, and you have to have billions of dollars of equity capital to do it. And that's what we did to create Stretch. So simple definition, digital money in our lexicon is 0% volatility, daily liquid instruments built on digital credit, like 0 vol 8% yield coin. And then digital yield, that's non-zero volatility, or it might be illiquid. It might be a 3-month lockup, 5x levered, 35% yielding fund that loops digital money 4, 5, 6 times in order to get there. And so digital yield is a levered construct, and digital money is the stripped down construct. We think digital credit's programmable across lots of dimensions. There are a lot of ways to add value to it. You can tokenize it, put it in a private fund, put it in a public fund, put it in a bank account. You can deploy it on a crypto exchange, on a neo bank. You can deploy it on a real bank. You can deploy it on a crypto network. You can program it to have volatility of 0 or let it float up to a volatility of 10. You could program the liquidity to be continuous or daily or monthly, but you could also put in a quarterly lockup or an annual lockup in order to put more leverage on it or create a different characteristic. You can program the yield from 5% up to 25% reasonably. Some people might go beyond that, but we think 5 to 25 is reasonable. And then you can convert the currency. You can create Great British pounds or euros or yen or Swiss francs with digital credit starting from STRC. And so when you think about all these different forms, the question is, do you want to create a yield coin, like a digital money coin? Do you want to create a yield fund? Do you want to create an account, right? And depending upon what your assets are, if you're the biggest bank in Australia, or if you're a Deutsche Bank, you probably would do it one way, but if you're a crypto exchange, you might do it a different way. The math is pretty straightforward. You start with 11.5% performance and like 3 vol right now. If we're lucky, maybe we'll be able to get our vol to 2 or to a 1 handle. I mean, that's the goal of our proposal to the shareholders. But I doubt seriously we get below a 1.5 or a 1 vol. 1 vol is sort of what publicly traded money market funds look like right now. But getting to zero vol takes a bit of work. So one approach to add value is to step it down, strip the vol to zero, and maybe instead of 3 vol 11%, you offer 0 vol 8%, and that's digital money. And the other approach is step it up, right? Lever it 3 to 1, pay 5% for the capital, and maybe you end up with something that's paying you like $35. You pay $10 on the capital, and you get a 25% yielding levered yield fund, and these are all opportunities. We are not going to do it ourselves. Our laser-like focus is make Stretch the deepest, most liquid, most stable, least volatile, highest Sharpe ratio credit instrument in the world. And that's a mission. But what we think is there are a lot of crypto innovators, and you see right here on this screen a lot of very impressive companies, that are moving fast right now. Apex has had enormous success early on. Saturn's doing the same thing, but Hermetica, Kraken, Roxum, Ondo, Pendle, Spread, Strata, they're all doing very interesting things right now, and they're very innovative, and they're moving about 10x faster than the TradFi complex normally moves on these sort of initiatives. But having said it, there's a lot of interesting TradFi initiatives, things you can do in a traditional finance environment, either with a private fund or a public fund, and we see those things happening as well. 8 weeks ago, there was no Stretch in the DeFi industry. And in those 8 weeks, we have rapidly grown to something like $270 million of exposure. So this is just really extraordinary, the rate at which money is flowing. Sometimes money is flowing into this complex $1 million an hour, $2 million an hour. It's starting to feel to me like we may very well see more than $1 billion of Stretch enter the DeFi industry in the near future. It's moving very fast and is very dynamic. So let's speak about outlook and our vision. We're a structured finance company, and you can see here we're taking raw capital, digital capital, 40 vol, 40 ARR, $1.6 trillion market cap of Bitcoin. We are stripping the currency risk. We are reducing the credit risk. We are compressing the duration risk. We are distilling a yield. We are damping a volatility in order to create various instruments. And our greatest product and biggest success right now is Stretch. As you can see, it's taking a 71 vol down to a 3 vol. We're targeting a 1 vol. Some important items to be aware. The Bitcoin break-even ARR, we calculate it all the time. It's very significant for this reason. If Bitcoin grows more than 2.3% a year, that break-even ARR, we can fund our dividends forever. We can fund our dividends forever without selling a single share of stock. It is a very critical point. If Bitcoin does not grow at all forever, we can fund the dividends for 43 years. We're very clear about this. You'll see we publish it on our website, and we update it every 15 seconds. So let's go to the next slide. Here you see, this is our website. If you go to the credit tab, you're going to see we show you the Bitcoin reserve. We show you the years of dividends. That's the years we have of coverage of Bitcoin appreciates 0% a year. And then we show you the Bitcoin break-even ARR, 2.27%. It's updated every 15 seconds. So for those people that are wondering, what is the credit risk in all of these instruments, I encourage you to go to the credit tab. You can go and you can type in, you can assume the Bitcoin price crashes to 30,000. You can change your vol outlook. You can change your AR outlook. The model will recalculate all of the risk and credit spreads for every credit instrument, and especially for STRC. And as I said, we're updating all of these things in real time every 15 seconds. There's there's a misnomer. Sometimes people think, well, Bitcoin has to appreciate 11% or 11.5% for us to be successful or cover the dividend. Not true, 2.3%. Or they think 30%. No, that's what we think it'll do. The number that really matters is 2.27%, the big BTC break-even ARR. Now, it's important for another reason. The BTC break-even ARR is also the inflection point where stretch issuance results in more Bitcoin being stacked by our company than the Bitcoin we use to pay dividends, if we choose to pay dividends with Bitcoin. So this chart here, what it illustrates is that we don't have to sell a single share of stock. We could stop selling MSTR common stock right now. We can fund the dividends with Bitcoin sales. And if stretch issuance is greater than that BTC break-even number, not only will we fund the dividends forever, we will increase the amount of Bitcoin that we hold forever at the same time. So you would say, well, how much is that? Well, you can see if we were to sell $1.5 billion of stretch per year, we can sell Bitcoin, pay the dividends, buy more Bitcoin than we sell, grow our Bitcoin stack, and generate Bitcoin yield. Now, of course, we sold $1.5 billion of Bitcoin in 1.5 billion in stretch in 2 days a few weeks ago. So yeah, I think we can definitely stay above that break-even point. What you see here on this slide is that if we actually have stretch issuance equal to 20%, that would equate to $12.8 billion of stretch sales this year. And we're kind of on the path to that if we look at the first 4 months of performance. We might exceed it, who knows? We might be less. But if we actually run at a 20% issuance rate, then the first order model shows or indicates that we generate a BTC yield of 17.7%. We accumulate an additional 144,000 Bitcoin, and that's after we pay all the dividends by selling Bitcoin. So again, the most important point here is there are occasionally some short narratives. People would say things like, well, if they sell the Bitcoin, that's bad for the business, or it proves the business doesn't work or something. But, we look at it as if you're a real estate development company and you bought land for $10,000 an acre and you sold it at $100,000 an acre, and then you bought more land with the profit. No, or if you sold it $100,000 an acre to pay some interest expense on debt that you used to buy more land, nobody would say that that's bad for the price of real estate, and no one would say that that proves the business doesn't work. Real estate development companies literally exist to buy land cheap and sell it expensively. We're like a Bitcoin development company. We buy it cheap, we sell it dear. Where do the dividends come from? Capital gains fund credit dividends, right? That is the essence of the business. We invest in digital capital, Bitcoin. The capital gains from the investment fund the credit dividends. They will do it in perpetuity if the capital appreciates at that break-even rate. And it turns out that sometimes we will sell a Bitcoin derivative because it's in the best interest of the company, but it's not necessary. This chart really illustrates that you can strip the business down to something very simple. You buy Bitcoin with credit, you let it appreciate, and then you sell Bitcoin to pay the dividend. And as long as you're issuing credit in excess of the break-even point, then this business works and grows forever. So how do we decide what to do? Because every single day we've got a bunch of trading decisions. Well, we have a very sophisticated equity and risk model. We calculate the benefits of the equity and the deltas to the risk for every single capital markets transaction. And that means we're making these decisions not just every day, oftentimes every minute of every day, based upon all the fluctuating prices of the trading pairs. Right now, our BTC rating corporately is about 3.3. The duration of our liabilities is 10.9. That's the stochastic duration. It's our estimate of the stochastic duration of all the debt and the prefs. The risk that we've centered on works out to 818 basis points, and that works out to a fair credit spread of 61 basis points. 818 basis points of risk means that there's an 8% chance at the end of the duration of the liabilities that you're trading at a BTC rating of 1. And 61 basis points is the credit spread a rational investor needs to be paid to offset the risk. What you can see here is two things. First of all, the assumptions we plug into the model to estimate that centerline risk is 10% BTC ARR. We assume that Bitcoin will perform about at the level of the S&P 500 over the last 100 years. It's a fairly conservative, realistic view, and we plug in 40 vol. We assume that the asset will remain volatile ad infinitum. So we see that as two conservative estimates. But even with those estimates, what pops out is a credit spread of 61 basis points. The investment grade credit spread is like 88. And so this is investment grade credit, even with very realistic, pragmatic inputs. Let's delve a bit more into this. Here's the risk model. What you can see, of course, is that if you're a Bitcoin maxi, you think Bitcoin's gone up 30% a year, there is no risk. Right? The more bullish you are in Bitcoin, the more the risk drops away. If you're a tech investor and you think Bitcoin's as good as a Mag 7 stock and it goes up 20% a year, the risk is fairly de minimis. If you're a trader and you think Bitcoin is no different than the S&P, well, then you're on that 10% ARR line. And then if you think that the vol stays constant, you've got that 818 basis points. If you're a skeptic and you think Bitcoin's going up 0% forever, the risk increases. And if you're a hater, pessimist, and you just think that Bitcoin is going down ad infinitum, well, then the risk actually explodes. There's a lot of risk here, and you can see it in the model. We will show you risk numbers here with that realistic view, as though you're an agnostic trader. You don't love Bitcoin. You just think it's just as good as any other equity capital asset that's diversified. You can see you can calculate the risk with various Bitcoin prices, and you'll get the answer you would expect. Bitcoin price going up is good. Bitcoin vol going down is good. And on the next slide, you can see you can slice this with various assumptions about the outlook of Bitcoin as well. So let's look at some trades. If we decide to sell $1 billion of MSTR stock and buy $1 billion of Bitcoin, if you do that at less than 1.2 MNAV, when you do it at 1 MNAV, you can see it's dilutive. It's a minus 48 basis point yield. It costs the shareholders $310 million. For that reason, not very good idea. What you can see here is that as the MNAV goes to 2 or 2.25, it becomes a screamingly accretive deal. At 2, you make $457 million in gains on the trade. We've broken it down to basis points of yield. It's also another point. 57 basis points of BTC yield's a lot of money. It's worth $1/3 billion. So it's not that complicated to see whether something's accretive or dilutive when you're swapping common for Bitcoin. You can also see here what it does to the credit risk. It improves our BTC rating. It decreases the risk. So whenever we're swapping MSTR for Bitcoin, it's credit positive. It's probably equity positive unless we're trading below that 1.22 break even. Now let's consider whether we want to use equity to pay the dividends or whether or not we want to use Bitcoin to pay the dividends. If we fund $1 billion of dividends with Bitcoin, it cost us $1 billion. It's $1 billion of cost to the shareholders. Look at the lowest line. You'll see it. It's a 12,763 Bitcoin loss, 156 basis points. And what you can see here is that's pretty comparable to funding the dividends with common equity at 1.22 MNAV. They're pretty much the same. If you fund the dividends with equity below that break even, it gets more expensive for the shareholders. You know, it costs you an extra $290 million to fund at 1 MNAV. So you'd be better off to sell the Bitcoin than to sell the equity on this analysis if the equity's trading weak. On the other hand, if the equity's trading at 2 MNAV, then it only costs, $535 million. So it's an 83 basis point hit instead of 156 basis point hit. So as you can see, we're always considering, do you use MSTR or do you use BTC to fund obligations of the company? What you'll notice is if you do use equity, it doesn't change the credit metrics at all because you're expanding the capital base of the company. With Bitcoin, it may be less dilutive, but it does slightly increase the credit risk. It drives down the BTC rating. The risk goes up 13 basis points. That would equate to like a 1 basis point increase in a credit spread. Now, what about funding the US dollar reserve to the tune of $1 billion? What you can see is, well, it's a lot more efficient for the shareholders to fund it at a high MNAV, like 2.25 or 2, than it is to fund it at a lower MNAV. And of course, it's constant to fund it at BTC. And that's the negative from the equity point of view. The positive from the credit point of view is it extends our duration dramatically. 160 days of duration. It decreases MSTR risk by 55 basis points. It improves the rating. Next. Now, what if we actually buy back one of the converts or some of the converts? You can see here, if we go and we sell $500 million of stretch to buy $500 million of convertible bond, we actually generate substantial BTC gains. We get a yield of anywhere from 22 basis points on the 2029 convert to 63 basis points of yield on the 2030 convert in the middle. So why? Because different converts have different equity content in them. And so some converts are more dilutive to the common than others. And you can see here all the analytics. You can see the impact on the rating. You can see the impact on the risk. Generally, we'll stretch the duration. We'll dramatically decrease the leverage. We'll slightly increase the risk. And we'll, of course, generate massive BTC gains through this trade. You have to evaluate this, of course, every day because the price of all the converts will be changing every day. And so this is an illustrative of the model we use. So what if we actually sold Bitcoin to buy the common stock back? This is not something that we have considered before, but I like to illustrate it because what you can see here is that below 1.22 MNAV, it's actually extremely accretive to the investors to swap BTC for MSTR. And so if you have an irrational market, let's say some crazy short seller shorted our stock to 0.5 MNAV. Well, the most profitable trade, in the entire model is to actually swap BTC for common stock at a massive discount to MNAV, and you pick up 636 basis points of yield, massive amounts of BTC gain. And of course, the opposite is intuitive. If you're trading at a high MNAV and you're swapping BTC for the stock, you're generating a dilution. So, you won't see us swap BTC at a high MNAV, but you might see us swap it at a low MNAV in the future. And you can see all of these trades, they have a small impact on risk, but it's fairly de minimis. It's primarily an equity dilution or accretion. And, you can see we can swap BTC for MSTR, but here another very powerful tool the company has is we can swap STRC. We can sell credit to buy MSTR. So over time, as the business model becomes more well understood, the company has the ability to do its own levered buyout or LBO on its own common stock. We can create amplification. I'm not going to use the word leverage because leverage implies that you've got a debt obligation that comes due. Really, it's amplification on the equity. And if we wanted to amplify the returns of the equity, we would simply sell the credit and buy back the common equity. And of course, we get to take advantage of market mispricing. If the market perfectly prices everything, we don't have great arbitrage opportunities. I mean, but you can see here, even if the equity was trading at 2 MNAV, we can generate 85 basis points of yield by swapping $1 billion of credit for $1 billion of equity. But if the market trades down to 0.5 MNAV, we can generate 800 basis points of yield. So it starts to become pretty accretive, and this is an option in the future that we have as an operator. And of course, we can actually sell dollars to buy common equity. So you can see the impact of this. And of course, probably one of the more expensive programs we have is to carry the US dollar reserve. It's dilutive to the equity. It's equity negative, but it's credit positive. And you can see we do have the option, if the equity were to trade to a discount, to actually swap the dollars back for the common, and it would be extremely profitable for the common stock shareholders to do that. So we've got some scenarios here. We can continue with our conventional strategy at 1 times MNAV. So even if the stock was trading at a discount to break even, if we're selling credit and selling equity, and we use the equity to fund the dividends, and we hold the US dollar reserve constant at 1.5 years, we would run a 10.6% BTC yield, and we would accrete up to 263,000 BTC per share, or Satoshis per share over the next 3 years. So you can see, even if the market conditions aren't great, right? We have a business to deliver 10.6% yield. The duration would stretch out a bit. The risk would increase a bit. The fair credit spread, looks like 94 basis points, but it's still just a shade off of investment grade. So that's a conservative case. Should the market continue, if we were at 1.22 MNAV, you can see that the yield expands to 12.2%. The credit metrics don't change, but this is really positive for the equity investors. And now here at 1.5 MNAV, you can see that the BTC yield goes to 13.4. So you can see market sentiment and confidence in our ability to maintain this business, or belief in digital capital, belief in digital credit, is going to drive an expansion of the MNAV, which is going to actually drive an increase in the rate of accretion of Bitcoin per share. It's going to drive the BTC yield up. It's going to drive Bitcoin per share aggressively. And then at 2 MNAV, you see the BTC yield of this strategy gets you to 14.6%. So those are just different scenarios showing how market sentiment drives the business. But negative sentiment, it's a pretty good business. We'll double Bitcoin per share over 7 years, and positive sentiment means that we will double Bitcoin per share faster. Now, the company, as I said before, it can fund its dividends without selling any equity. We can fund the dividends by selling Bitcoin, and we can still grow Bitcoin holdings continuously. So here's a scenario where what we do is we fund the dividends, we fund the USD reserve at 1.5 years. We do it by selling Bitcoin, and you can see we drive a 12.2% BTC yield. We go from the 670,000 BTC level to 850 to 950 to 1 million. So we'll go through 1 million Bitcoin held on the balance sheet in the next 36 months. And we'll do that while funding all of our obligations with Bitcoin. You can see the impact. The impact that's measurable is a slight increase in credit risk and a slight increase in credit spread, but I think it would be a second order effect of the market. So this is interesting to keep in mind. Now, what happens if we fix the US dollar dividend and fund dividends with Bitcoin? Here, what we do is we just hold the dividend at 2.25 billion, and we pay all of our obligations by selling Bitcoin. And what you see is we get to a 14.7% BTC yield. Again, a slight increase in credit spreads, a slight increase in risk. But, this is without accessing the equity capital markets at all to drive the business. And, we're looking at first order effects. We're not really showing the second order effect and the third order effect. There are tax credit advantages that are second order effect. There's reflexivity in the common stock itself. It might very well be that, if people decided we weren't going to sell any common stock, they might actually decide that the rational MNAV should go to 2 or 3 or 4. And so we can't really model those. What we can just illustrate here is that even the first order model, it's pretty clear that the company has the option to run on the Bitcoin engine or on the Bitcoin derivative engine. MSTR is a Bitcoin derivative, and either of them are options. Here's a scenario where we just retire all the converts. And if we diverted 20% of the stretch issuance to retire debt, we retire all the debt in the next 3 years. We'll go from $8.2 billion of debt to 0. Net leverage goes to 0. The duration of our instruments goes up to 15 years. There's 114 basis points of credit spread, on the digital credit, but there is 0 leverage. And we run with a 12.4% yield, and we maintain this constant 1.5 year USD reserve. And so you can see that's kind of interesting as well, and an option that's available to us. So here's a table that just shows all the various options. And of course, there's a lot of other things. We've got a sophisticated model. We can plug in any possible trade and any size on any day of the week. And rest assured, we're considering these every single day, and we're programming trading algorithms to trade all these instruments, sometimes every single second. And so the key point that Fong made is the optionality in the business is expanding dramatically. You can see on the equity side, our assumptions are 30% BTC ARR, 20% stretch issuance, 11% dividend rate. On the credit side, we're much more pessimistic or conservative, or you could call it realistic if you want, 10% BTC ARR, high vol. If Bitcoin vol starts to fall as Bitcoin price appreciation accelerates, we have a lot of other options we can take advantage of, and rest assured we'll jump on top of those. I thought I'd show one last slide of interest here, which is sometimes people have this misnomer. They think that we're borrowing money at 11.5% and it's a fixed obligation. That's not correct. We're not borrowing money. When we sell $1 billion of stretch, we're never paying it back. And so the first obligation is stretch is a perpetual swap. It is not a loan. And the second observation is the cost of capital is not 11.5%. There is a stochastic cost of capital. What stretch is a perpetual swap where the issuer agrees to pay SOFR plus a credit spread, a variable credit spread adjustable each month. And then the issuer invests that in Bitcoin. So we are paying SOFR plus a credit spread. We are taking back the Bitcoin return, and the company, the issuer, has a couple of very powerful options. One powerful option the company has is over time to reduce the credit spread. That is an option. And of course, the credit spread is probably at a high point when you're early in the industry, when digital credit is not understood. But you would think after 3 years or after 6 years or after 9 years, the credit spreads will compress as confidence in Bitcoin grows, as confidence in stretch grows, as AUM grows, as confidence in the business model grows. The credit spread should compress. The second option is the company has the option to lower the dividend to a floor of SOFR. So as SOFR falls, when SOFR's 375 basis points, that's the floor. But if SOFR goes to 200 basis points, the company gained 175 basis points of additional optionality. SOFR has gone to 0 or 25 basis points in the past. So the fact that SOFR generally fluctuates between 500 basis points and 25 or 50 basis points on an 8-year cycle is a very important point. And when you consider those two options, the stochastic cost of capital for stretch, has to be modeled as something less than 11.5%. maybe more than the long-term rate. If you imagine SOFR is 2 or 3% and we have a 300 basis point credit spread 20 years out, that might be 6%. So somewhere between 6% and 11.5% gets you to like a blended rate of 875 basis points. So when we think about the cost of capital, we think that it's probably 875 basis points and the debt's never coming due. And I think that's an important point to make to the world, and it colors your thinking. And so with that, I'll just end with our capital markets principles. And I'll reiterate what Fong said. You know, we're here to drive Bitcoin per share up, and we're doing everything we can to drive Bitcoin per share up. We think the best product and the best tool to do it is Stretch. And it's clear the market's telling us that. And so we will focus laser-like on making Stretch the best digital credit instrument. We do see a world where we're debt-free, and sooner rather than later. We're going to adjust our amplification and our credit metrics and our US dollar reserves and our use of proceeds based upon market feedback. We get market feedback every minute. We're literally staring at all these signals every minute. And of course, we're talking to every credit investor and every equity investor continuously. And again, with Bitcoin, the company's got more than $60 billion of Bitcoin, and the Bitcoin market has $20 billion or more of daily liquidity. If we were to be boxed in by a troll or a cynic or a skeptic into agreeing that we're never going to sell the Bitcoin and we're never going to tap the liquidity, we would be impairing the asset which accounts for 99% of the future of the company. So, you know, it's kind of like a real estate developer saying, I'm just never going to sell any real estate ever at any price. It's kind of a silly thing. If a wealthy person, you know, if a billionaire sells $1 million or spends $1 million to make $1 billion, nobody says they're poorer. And nobody would lament that spending a few $1 million is going to crash the U.S. currency either. I don't think that if we spend $100 million of Bitcoin or sell $100 million of Bitcoin to pay a dividend, I don't think it's going to negatively impact the Bitcoin network. I think it's probably good for the Bitcoin network. It definitely doesn't impair our business model. If anything, it just creates more optionality and second and third order effects. So the management team's practice is to run the company in the best interest of all the stakeholders. And that means there are three that we laser-like focus on. Whenever we're making a decision, we ask the question, is it good for the common equity, MSTR? And we ask the second question, is it good for the creditors, especially STRC investors? And the third question we ask is it good for the capital investors, BTC investors? And we happen to believe that running our business in such a way as to commercialize digital credit in the most efficient fashion is the best thing we can do for Bitcoin and Bitcoin investors, the best thing we can do for digital credit investors, and the best thing that we can do for our common equity investors. There is no conflict between those three goals, because if we sub-optimize to the benefit of one to the detriment of the other two, the entire machine doesn't work. And so when we balance the interest of the three, the more credit we sell, the higher the equity MNAV, the higher the equity MNAV, the more credit we can sell, the less the credit risk, the more Bitcoin we can buy, the better it is for Bitcoin. The better it is for the price of Bitcoin, the less risky the credit is, the more profitable the equity is. There really are concentric flywheels here, feedback loop within feedback loop within feedback loop. And when we're in harmony, all of those feedback loops are working really well. And you can see that happening in the market. We monitor it. And indicia of everything working is when the MNAV is expanding and the equity is healthy and the equity is outperforming Bitcoin, when the volatility of Stretch is falling and liquidity is increasing, right? That is indicia of the success of the credit. And when Bitcoin price is appreciating, and Bitcoin support and liquidity in the world is appreciating, that's indicia of success of the capital. And so that's what we've been doing. That's what we'll continue to do. And we thank you for your support. Now I think we'll open it up for Q&A.
Thank you, Michael. So before we jump into the Q&A, I'd like to just share with all our investors that we're organizing a special Q&A for retail investors next week on May 13th. You can scan this QR code if you'd like to submit questions. We'll share the link on X and we'll share more details as well. With that said, let's jump into the Q&A. I'd like to invite all our guests to turn on the cameras. Get ready to ask some tough questions. Let's get started with Pete Christensen from Citi. Pete, please go ahead.
Thank you, CJ. Trying to start the video here. I think it's disabled. Anyway, hop right in here. Michael, I just want to, hopefully we just can take this call and how you've laid out, I think, all these scenarios, and think about, like, in historically, I guess, well, I'm pointing to last year, the end of last year, that there was a false signal that strategy was selling Bitcoin and it was taken negatively in the marketplace. Today, you outline a lot of different optionality scenarios that strategy now has to optimize its capital stack. Should we take today's call as a signal to the market that, yes, strategy is willing to be more proactive with its capital stack, which may include the sale of Bitcoin, maybe for tax purposes or maybe for other optimization purposes, credit, what have you? Should we take today's call as a signal that, yes, strategy is going to be more tactical with its capital stack going forward?
Yeah, you should. I think the company got much healthier when we proactively began to utilize the equity ATM, and we said we're going to do it. We're not ashamed of it. We'll probably do it again. And then when the company started proactively executing on the credit ATM, and we said we're not ashamed of it. We're going to keep doing it. We think it's good, and we've got a plan for it. And now I think at this point to say we're turning on the BTC drive, we're not ashamed of it. We got 65 billion. We have a $2.2 billion tax credit that's lying on the floor. We ought to go find a way to pick up the 2.2 billion, right? And just like, with everything else, the more optionality we create and the more tools we have at our disposal, I think the better it is for the equity investors. We'll probably sell some Bitcoin to fund a dividend just to inoculate the market, just to send the message that we did it. Look, the company's fine, the Bitcoin's fine, the industry's fine, the world didn't come to an end. And if you're a short seller and your thesis is the company's got to sell equity in order to fund the dividends, I would like nothing better than to, rip your wings off.
I like that term, inoculate. Very well. Thank you.
Thank you, Pete. I'd like to invite Jeff Bach next.
Hello. First off, congrats to the team, particularly on Stretch's accelerated reach, and happy to be a part of this. Thanks for having me here. My question's focused on understanding how macro factors may influence the firm's Bitcoin acquisition strategy, and particularly in regards to interest rates. As we all know, we're just about a few weeks away now from Kevin Warsh's official inauguration, and even though rate cuts odds are a little lower this year, strategy now does have like an explicit growing interest rate sensitivity, right? As we just saw from the stochastic model. And so if hypothetically we see interest rates being lowered, Stretch has this momentum that it will likely trade above par more aggressively, given the nature of like the floating rate dynamic. And now the company has like a really, really interesting fork. You can either, one, issue more Stretch and push the price back down to par, or you can actually use that moment to reduce the interest burden itself, right, on what's outstanding. And there's a healthy tension between these two things. I guess my question is, can you help us understand that risk framework a little better to calibrate that particular trade-off, right? Lowering the coupon versus selling STRC, it changes a little bit of the Bitcoin acquisition velocity, but it also cuts interest expenses, especially in that lower rate interest environment, and any specific like input parameters that you might say takes priority here in your calculation.
I'll start, and then Phong or Andrew may have some comments. So first of all, when the macro indicators are moving against us, we've got a headwind, everything slows down. right? And when we go to a restrictive monetary policy, that's bad for Bitcoin. That's really bad for Bitcoin. It's bad for risk assets. Bitcoin is risk assets squared. MSTR is risk assets cubed. So I feel like we're like tech cubed and big tech cubed, and Bitcoin is big tech squared in a risk off environment. And you could see that. In a risk on environment or a more accommodative monetary economy, I expect you'll see the opposite. I think Bitcoin will rally hard as squared. Our equity should rally as tech cubed. The credit, presumably, we have more optionality if SOFR falls. Our bias is to grow the business responsibly, but as rapidly as we can. And our bias is to grow Bitcoin. So if we have the ability to accelerate our capital raising, and we could raise twice as much capital in a risk on or a looser, more accommodating monetary policy, we will run the vehicle as hard as we can, but we won't run it so hard that the capital structure doesn't keep up with it. So the circumstances under which we would slow down or want to throttle the credit would be if we go to risk on and Bitcoin doesn't rally and our equity doesn't rally, but the credit rallies. Right? So if the demand for the credit triples and somehow Bitcoin and Bitcoin doesn't react to the interest rate macro environment or MSTR doesn't, then we might very well say, well, we're going to want to adjust the dividend rate down because we're getting too much demand for the credit. By the way, Jeff, I don't think that'll happen, right? I think the likelihood that we go to a risk on environment and Bitcoin doesn't rally is small. So then if Bitcoin rallies, then our capital stack and our collateral base expands, and then we can accommodate more credit. So the rate of stretch issuance or credit sales is a function of the BTC growth rate or ARR. If Bitcoin grows 30%, we can expand, credit aggressively. If it grows 50%, we could go faster. And then the second order is really the equity capital markets enthusiasm for our business model. So if the equity capital markets looked at our business and said, okay, we're going to run a BTC yield of 20% a year, and I'm going to give you a P to E of 10, I'm going to give you a 200% premium to NAV, and you're trading at 3x MNAV. Well, that would be better than we are right now. If the equity capital markets did that, gave us a 10 P to E on BTC yield or BTC gain, then of course, our optionality increases, we grow faster. And, the countervailing view is, well, you've only been doing this for a year or 2 years. And so the Lindy effect says, I'm only going to put a P to E of 2 on that. And so if we get a P to E of 2, we could have a Bitcoin rally that gets us a collateral stack, but the equity doesn't go as fast. And that might govern the rate at which we run the credit engine. But the bottom line is, if Bitcoin, if the macro environment turns risk on and expands and Bitcoin rallies, our equity rallies, it's go time, we're going to go, and we're going to go with the credit. Like, we're going to use the credit. Make no mistake about it. We want to see the MNAV, the equity is undervalued. We want to see the MNAV expand to 2, 3, 4, 5, or 6. And nothing would make me happier than to rip the faces off of all the skeptics and the shorts and drive the equity to the moon. And I think the question you got to ask yourself is this company going to sell $10 billion of stretch this year, or 20 or 40 or 80, right? And the answer to how much we can sell responsibly is a function of where the Bitcoin price is, and to a lesser extent, how the equity capital markets react. If the equity capital markets are accommodating and supportive and Bitcoin rallies, the company has a lot of tools to manage the BTC rating and the collateral coverage, and we can add more equity capital. And you could see, I just showed you, we can put equity capital in the market fast. We're the biggest equity issuer last year and this year. We could also take common equity out of the market if we decided to. What we're going to look at is we're going to look at the interest rate forward yield curve. We're going to look at how Bitcoin performs. If Bitcoin keeps performing as big tech squared, we're going to look at the forward curve, or the forward expectation curve of BTC. We're going to look at the forward vol curve, right? If Bitcoin at vol 40 or 35 is different than vol at 50 or vol at 20. When Bitcoin vol falls to 20 or 25, so you can lever common equities and still have investment grade. You can lever 2, 3, 4, 5x more and still have investment grade. So what we're going to look at is, by the way, Bitcoin we're going to look at the interest rate is not the same as institutional credit. We're going to look at how Bitcoin performs. Bitcoin keeps performing. So the forward yield curve, the forward vol. We're going to look at the forward price curve, the forward, the forward expectation curve of BTC. All that stuff gets discounted. We're going to look at the forward vol curve. Right? Bitcoin at vol 40 or 35 is different than vol at 50 or vol at the end of the day. When Bitcoin vol falls to 20 or 25, so you can leverage common equities, drive the MNAV. You can leverage 2, 3, 4, 5 to the sky and drive the Bitcoin price. What we're going to look at is, and to build, we're going to look at the interest rate because it's not the same as in the world. We're going to look at how Bitcoin we have more liquidity. So the forward yield curve, liquidity for STRC. We're going to look at the forward. The ball will keep coming off. Adoption will expand as we get a network. All that stuff gets so. Yeah, I think, you know how Amazon gave like free shipping or shipping for $10 a month, and everybody said you're losing money on that, and they lost money on that for a decade, and then one day they just raised the price, and they were the only player in the world, and they made a fortune, and people, thought, well, I guess that was a good idea. I think we would like, if you gave me a choice, do I want to sell $500 billion of stretch and pay 11%? Or do I want to sell $50 billion and pay 9%? If you know me and the company, I think you can guess which of the two we want. At the end of the day, our long-term view is Bitcoin's going to go up more than 11%. It's going to go up 30%. And if we're wrong, it's 20%. 200 basis points won't make the difference one way or the other. But I rather think that if we gather an extra $100 billion of capital, I think the war to determine the future of the credit markets and the war to determine the future of money is going to be fought and won with money. And so we're going to get the money if we can do it in a responsible way, right? And at some point, if you have this perverse random situation where Bitcoin price is not reacting and MSTR is not reacting, but everybody I can't imagine that credit investors are more bullish on Bitcoin credit than equity investors or Bitcoin investors. But if you construct that tortured scenario, then maybe we would slow down the credit machine. But if equity investors are more bullish than capital investors, and if capital or Bitcoin investors are more bullish than credit investors, then I think the entire system solves its own problems, because we're probably not going to be able to keep up with the expansion of our BTC collateral stack.
I'll add one short thing to this, Jeff. I think the scenario you lay out is in a maturation of the digital credit market, right? 5-10 years out, when digital credit is 3 or 30 trillion on a $300 trillion market. We would run into this issue of how do you manage the demand for stretch. I think 10 months into it, I think our issue is not so much what interest rate or are we paying or what does the Fed do to interest rates. I think the demand is going to be driven by awareness and marketing of the product right now. So I don't think that scenario is going to be much of an issue for the short term.
Got it. Thank you for those thoughtful responses. We'll take it in depth.
Thank you, Jeff. Next, I'd like to invite Andrew Hart from BTIG.
Hey, thanks for the question. I think the optionality in the business really came through clearly today. Maybe just shifting gears a bit. Earlier in the slide, Michael, you talked about Bitcoin being digital capital and MicroStrategy being digital equity and Stretch being digital credit. Then you also talked about kind of innovators kind of building digital money down the road. So you called it like a layer 3 in that example. I guess considering Stretch is going to be the foundation or the building blocks for digital money at some point as the market continues to mature, I guess, what do you think that solution looks like? Are you having conversations with innovators who are out there looking to build on top of Stretch and create these digital money solutions? Thanks.
Hold on. Sorry. Can you hear me?
Yeah, I can hear you.
Oh, you hear me fine. Okay. I think you see it with Apex and Saturn and Hermetica and a lot of the token issuers that are creating these yield coins that are powered by Stretch. And so they're rapidly innovating. I think if you look at some of the DeFi protocols that are offering, 2x, 3x, 5x, 10x leverage and looping, Pendles of the world and the like, I think they're also innovating pretty rapidly. We don't know the final shape. I think there's 1,000 different combinations of digital money and digital yield. I think there's a different currency in every country. I think you can create various yield coins in different currencies. I think that in Australia you can deploy it via a regulated bank or via a token that can sell in Australia or via an ETF taken public in Australia or via a private fund in Australia. So when you take the combination of currencies and platforms and containers, the sky's the limit. But what I do notice is the people that seem to be moving the fastest and the most enthusiastically right now are the DeFi players. And it's people that are launching stable coins that have to compete with Tether and Circle. And the issue is, how do I convince people to put AUM or put capital into my stable coin? And I need to create either a digital monetary, a yield coin, 0 vol, 8% yielding. I mean, that's kind of compelling. Or I need to create like a 25% ARR, staked lock, I lock up your money for a month and I'll give you 25% on 3 or 4 turns on the capital or something. And obviously the market's going to decide who it trusts, and it's going to decide what form of that it wants to buy, and it votes with its money. And you can literally watch the money flowing every hour in that system. I think you'll see some ETF players, but they'll come slower because there's more regulatory friction there. And we hold out hope that we'll see a neobank offer a digital yield account. There's no reason why a bank or any neobank that is a mobile app couldn't just say, hey, we'll just give you 8% on your money in this yield account if you want it. Each one of these things, it's a different counterparty, a different platform, a different regulatory container. What I would say is we had none of these conversations going on 8 weeks ago or 12 weeks ago, and now I see like 3 dozen initiatives. And so I think there's Cambrian explosion, and check back in 12 more weeks. I think we'll have some exciting news and some exciting partners, or just watch my X feed, because I retweet some of the more interesting digital yield, digital money offerings that are literally happening. A lot of times people are inventing stuff and I'm finding out, at the same time you are, but the market's evolving in real time right now.
Thank you, Andrew. Next, I'd like to invite Eric Balchunas. Eric, please go ahead.
Yeah, hi. Thank you for having me today. Great presentation. My question's maybe a little more philosophical. I think it impacts the price in the future, but it's about the changing ownership and identity of Bitcoin. So according to River, in the past 16 months, you've had businesses buying 560,000 Bitcoin, ETFs bought another 208,000, governments bought 160,000. So that's a million total Bitcoin by those entities. Meanwhile, individuals sold 730,000 Bitcoin. Some have called this the silent IPO, and it's arguably the reason for that 45% drawdown. This changing ownership is being reflected, I think, at the recent Bitcoin conferences, where you see an increasing number of suit coiners, as some have called them, which you highlighted in the slide on the government and the banks. And I've noticed it's made some of the native Bitcoiners a little uncomfortable and conflicted regarding the original mission, given it was made to bypass governments and banks. To me, it feels like Facebook 10 years ago when everyone's parents joined. Some people left the platform, although the user base did grow from 1 billion to 3 billion since then. And I just want to get your read on this transition and the sort of mainstreamification of Bitcoin and how important it is to keep the original base of investors, keep them along for the ride, and keep the sort of cypherpunk edge of Bitcoin as it goes more mainstream and gets adopted by companies, asset managers, governments, and boomers in general. Maybe it doesn't matter, given the size of the institutional and advisory market for that price, maybe hitting $1 million, but maybe it does. Just curious your thoughts.
Well, I'll make a quick point. Since we got into this space, there's been something like call it $1.4 trillion of wealth created for people other than the suit coiners. So I don't know who got the money, but there's certainly I think we can trace 4% to BlackRock investors, and they must have 50 to 100 million beneficiaries. You can trace almost 4% to our investors. We've got 100 million beneficiaries. So, if you look at the corporates, they're representing thousands of institutions and tens of millions of investment accounts and hundreds of millions of beneficiaries. And the network is decentralizing. It is distributing through them, and it is maturing through them and finding its way into retiree accounts and insurance beneficiaries and trust funds and 3-year-old, trust fund babies. Everybody in the world is getting exposure now. But, when everybody criticizes the centralization of the network, I note that 85% of the network is held by others. It's held by the crypto OGs. And we don't know how many people that is, but it's almost certainly represents fewer beneficiaries than beneficiaries that rely upon BlackRock's ETF or a common public stock. So the corporations have been spreading exposure to Bitcoin by an order of magnitude or orders of magnitude right now. I do think that, if you ask, well, who owns the $1 trillion of Bitcoin that's not public? And the Chinese, there are Chinese, there are Russians, there are Americans, there are Europeans, there are South Americans, there are Ukrainians, there are Iranians. When you wonder who's selling it, well, it's $1 trillion of capital held by crypto OGs that are unbanked. Maybe they're selling it because, the currency in Iran crashed. Maybe they're selling it because of some fear of, some Chinese government memo. If the Chinese mined half the Bitcoin in the first 15 years, it's kind of impossible that there aren't a lot of people with Bitcoin in China, you would figure, since they mined a great deal of it. So I think generally the industry's maturing. It's rotating from the crypto OGs, but they're not going away, right? We spent $62 billion to get to less than 4%. It's pretty expensive to not get to the other 96%. And if you look at all the money that BlackRock and us put in this together, right? The 150 or $200 billion of capital that flowed from the institutions, it didn't get 90% of the network. So 90% of the network is still in global crypto OG hands. And I meet people, I go everywhere in the world. I'll walk down the beach and there's someone that's slapping me on the back, thanking me for making them a lot of money, right? And it's because, literally people that you will never know who they are and they will never announce it. They're sitting on $1.2 trillion of capital gains right now in the crypto ecosystem. So I guess what I'm saying is I'm not worried that the crypto ethos is being squashed. people with $1 trillion probably have a lot of power to do whatever they're going to do, and they're continuing to do it. The Bitcoin network is still highly decentralized. The miners are decentralized. This is a global phenomenon. If anything, what's happening is the corporates are just powering up the network. We're the people that invest the 100 or 200 billion dollars of capital to drive the price from 10,000 to 80,000, or from 10,000 to 100,000. But when we do it, 90% of the gain goes to other crypto actors, and they power the entire decentralized digital economy. And good for them. That's good. They'll do whatever they're going to do. I think that if you want to, I don't use the analogy, it's like Facebook when your parents came along. I use the analogy, it's like the internet when it used to be a girl or a dude in a dorm posted their blog on their webpage, and then all of a sudden Amazon started selling hundreds of billions or trillions of dollars of products on the internet, right? It's just we started doing business with digital assets. And ultimately, you know, the killer app of Bitcoin that we see is digital credit. And the way you know it's a good app is when someone wants to buy $1 billion of your product a day, right? That's, I mean, everybody in the entire crypto ecosystem has always dreamed about, let's invent the killer app. And a good product is something that people will buy $1 billion a day of. And there aren't that many in the history of the world. And we found one. So I think that the networks are going to grow. We're going to power it up. You're going to see an explosion of all the other crypto ideas. Whatever crypto idea didn't catch fire over the past decade, now they've got 10 times as much money and opportunity to catch fire, and some of them will, and the ones that won't, because the market doesn't want them. But the industry is, the network's evolving in every direction simultaneously. And I would take issue with anybody that ever said it's centralizing. It's absolutely not. It's decentralizing. The truth of the matter today is that there's a lot of people with money and power and influence in the world that are going to support this network and defend this network because of the success of all the corporations, whether it's Coinbase or whether it's BlackRock or whether it's Strategy, right? And if you're going to lobby for things that are good for digital assets in Washington, D.C., it's not going to be a Chinese crypto pseudonymous billionaire hiding off the grid that's going to do that lobbying, right? So the $1 trillion of crypto OG money is not going to fix the accounting, fix the tax code, fix the banking system, and build the technologies that actually commercialize these apps to 1 billion people. They're not going to give a bank account to 1 billion people that pays them 10%. And they're not going to put, the crypto OGs are not going to put Bitcoin on every iPhone and every Android phone in the world. That's going to be corporate actors. And so the corporations are doing their part. The crypto OGs did their part. Everybody's in the system. There's tension. It's healthy tension. We welcome the healthy tension. It's what the global the fact that, you know, someone's going to sell Bitcoin because they're in Iran and some missiles got launched, right? That's a feature, not a bug. It's just, you know, people are trading based upon things that have nothing to do with the way Wall Street trades the S&P index. And I think that's what makes Bitcoin special. And that's why we welcome it as global digital capital.
Thank you, Eric. Next, we'll invite Ramsey Yalasal from Cantor.
Hi, thanks for taking my question tonight. Michael, you mentioned that if Bitcoin volatility were to fall as the asset price accelerates, you'd have some options and cards to play to preserve the attractiveness of the model. I'm just wondering if you can kind of elaborate a little further on what you meant there. And then completely separately, I was wondering if you could just give us a quick update on the BTC security initiative. How has that been received? And has there been any developments on the quantum risk topic worth calling out? Thank you.
I'll answer the first. I'll let Fong answer the second. If you go to our credit tab on our website and you type in a vol of like 40, and you have a BTC rating of 3, stuff starts to look sort of investment grade. When the vol falls to 30, you know, you can have a BTC rating of 1.5 and it looks investment grade. When the vol falls below 30, you know, your amplification can triple, quadruple, you know, and so as the vol falls, the credit risk falls. So I think that the forward volatility curve changes the view of credit investors and is going to create more demand amongst more traditional credit investors. And it's also going to change the view of banking regulators and you know, credit rating agencies and the like. So you know, there's a certain gift here, or a certain what is the word, like nuance. If the vol is high, it's equity positive. You know, today I think on CNBC at like 3:50, they said the largest options trade in the entire market, in the entire stock market today, was an MSTR options trade. Someone traded hundreds of millions of our options today in the market. Number one of all companies in the entire United States. That's because of the vol. So when vol is high, it feeds the equity market, and that's good, and it's equity positive. When the vol falls, it won't be so good for the equity, but it's very credit positive. And the answer, you know, the conclusion you come to is you're going to get performance through volatility on the vol side, and you're going to get performance through more amplification and more intelligent leverage as the vol falls. And of course, the entire asset class is going to expand, and people's view of it is going to improve as the vol develops, as the vol, you know, falls. I do think over time, over the long time horizon, if the asset's 40 ARR, 40 vol, it's reasonable for it to eventually mature to be 20 ARR, 20 vol. I mean, it's just kind of common sense that as it gets bigger and it gets more liquid, the law of large numbers and the inertia of the market and its relative size to all the other pools of capital are going to damp the vol. I think it'll always be more volatile than the S&P and always be more useful. But I think that if you're a credit issuer and a credit investor, you just want to be sensitive to it. And, you know, certainly right now, the single number one issue in the entire market is, what is your forward volatility curve for Bitcoin? Because if you think that Bitcoin is a 30 vol asset, everything we sell is investment grade and it should be priced double or triple what it is. If that's what you think. And so your view of volatility will control how much of this you want. If the vol starts to fall, there's just no reason why there shouldn't be, you know, a 10x bid on all this stuff. And then you might decide, rather than levering it 3-to-1, you lever it 8-to-1, right? Or something. And so it'll change the behavior of all the downstream players as the vol increases or as it changes. Okay, so Fong, you want to talk about security?
Yeah, Ramsey, we started to bring together a group of folks calling it the Bitcoin Security Program or Council. And the objective is to bring together institutions that represent custodians, exchanges, large Bitcoin treasury companies who have a vested interest in the success of Bitcoin and share a combined point of view on what is the potential risk and time horizon of quantum, what activities are underway in the development community, how do we get to consensus? And so likely in the next month or so, we'll share who's in that group and what is our combined point of view. Right now, I'd say there's a lot of divergent point of views, and I thought it would be useful those who are interested in the success of Bitcoin bring something together. And so you'll hear from the Bitcoin Security Program likely in the next month or so.
Excellent. Thank you. Appreciate it.
Thank you, Ramsey. Next, Jeff Walton. Please go ahead.
Thank you for including me, and very appreciative of your leadership. And I've got a bit of a two-parter here. So you spent a lot of the presentation talking about risk of the credit instruments. You've created a really unique arbitrage surface between all of the different instruments and a really unique incentive structure. It's resulted in people buying and selling the instruments right below par on STRC and some of the other instruments. So first question is, do you find that the market agrees with you? This is kind of in line with the answer to the last question on forward-looking volatility curve. Do you find that the market agrees with you and the instruments are trading in tandem with each other What's the biggest hurdle in communicating that relative risk profile? And then part two is, what is the biggest hurdle in accelerating the adoption of the digital credit instruments into the future?
Well, I think all the credit instruments are undervalued. So no, the market doesn't agree with us. If the market agreed with us, then STRF would be trading $200 a share right now, not where it is. So I think the equity is trading weak. I think it's undervalued. I think all the credit instruments are undervalued. I think all the bond instruments are way undervalued. So I would say the market is much more skeptical and biased pessimistically than we are. That's why, for example, we're not selling STRF, STRD, STRK, STRE, and we don't really have much interest in selling MSTR. We think all of those assets are undervalued. The STRC is special because, as we pointed out, it's a variable monthly preferred. And so the stochastic cost of that capital it's hard to determine over 20 years, but you're not locking in a mispriced trade. And so I have a lot more enthusiasm to sell $1 billion of STRC at 11.5% than I have enthusiasm to sell $1 billion of STRF at 10%, right? So no, I think we're embryonic. I would say how do we fix it? It's a Lindy effect. There's a lot of education. We have to go and educate the market. So you could say part of it is we have to tell the story, and you could say part of it is people are just going to have to wait, right? Like after we've been in the market for 3 years, they'll say, well, it's worked for 3 years, and so I guess it's better than we thought it was. So I think we'll be continually re-rated up. I mean, the risk will be rated down, and the opportunity will be rated up as time goes by. I would say we won't be sitting on our hands, right? We'll be out there communicating the message, displaying it. Well, partly we'll do it through publishing, partly we'll do it through investor outreach, partly we'll do it through partners. I think as our partners create compelling, digital money products or the like, I think that's helpful. And I think if you just ask the question, how long will it take? How long did it take before the market thought that Amazon had a good business, right? It took 10 years after they started doing what they were doing. And so you could be a pessimist and say it took 10 years for that. And how long did it take before Netflix was deemed to be good? The truth is Apple was mispriced and misunderstood for many, many years. So I think if you have a revolutionary business, I think that the market will be biased skeptical because that's just what it is. It's going to be skeptical of, the market was skeptical of Google, Google, Amazon. The market was skeptical of NVIDIA, skeptical of Apple, skeptical of whatever. It will be skeptical of digital credit, and digital treasuries for a while. And then there'll be some point when it isn't. And just like Warren Buffett comes in and buys some Apple and the stock price doubles and the multiples expand from 10 to, PDs of 10 to PDs of 20 or 25 or 30. It'll happen at some point when we least expect it to happen, but we have to do all the hard work of performing, laying down the track record, and educating the market and managing the risk of the business and the like. And so that's what we're doing. I think if you want the optimistic observation, well, the fact that the market's willing to buy more of that STRC is the most successful preferred stock in the world in the century, I think that's an indicia that maybe some people get it, right? So there are a lot of indicators that it's working and it's spreading fast and virally, but we still have a lot of work to do.
Thank you, Jeff. Next, I'd like to invite Randy Binner from Texas Capital. Randy, go ahead.
Yeah, thanks. Hey, Michael, I think this one is for you, and hopefully you can hear me okay. The question I have, so we talk about a lot, the Clarity Act a lot, and it's, I think it's important for the broader crypto ecosystem more, and this bipartisan compromise is good news. But for MSTR, for MicroStrategy, for your world, what would be the most important regulatory or policy change or impact? I think, I think we've talked about bank and insurance companies being lobbied to, recognize crypto as a statutory asset. Is it something like that? And the follow-up question, in case you cover this along the way, is at this point, with so many arrows pointing in the right direction for crypto regulation and guardrails, do the midterms matter that much? And for that matter, does the next presidential election matter much from kind of a policy and regulation perspective?
Bitcoin's in a safe harbor. There's global consensus as digital capital. MSTR is sitting in a safe harbor. It's a publicly traded, well-known, seasoned issuer, came public in 1998, governed by securities laws that, date back 100 years. STRC is in a safe harbor. It's a publicly traded preferred stock based on 100-year-old tax law, 100-year-old securities law, trading on, the NASDAQ exchange, which has been around for who knows how long, longer than many of us have been alive. So everything that we're doing is sitting in a zone of regulatory clarity. I don't think we need any change in a law or a rule in order to 10x or 100x. We can probably be 100x bigger from here without any change in any law or any rule. We're not asking or looking for anything. I think that clarity is pretty important to the dynamic and the balance of power with regard to token issuers, DeFi exchanges, stablecoin issuers, crypto exchanges, and it determines the balance of power between the crypto industry, the neo banks, and the regional banks, and the systemic, the big banks, and so there's a lot of dynamics there that are almost too nuanced to get into right now. The significance to us is just ignorant skeptics will gloat if it slows down, and they will all flip to uninformed cheerleaders, or acknowledgers if it passes. But there's not anything that we need. It's just going to change sentiment. It's going to be a positive bullish sentiment as it goes through. Long term, if I look at my laundry list of things that are good for Bitcoin and good for us, it's a second order, not a first order, but the second order is the Basel rules, to the extent that they're upgraded to recognize Bitcoin as legitimate collateral and not haircut it. It would be positive for banking adoption and especially credit adoption, because right now there's still a bit of haircutting of it by the credit rating agencies and the very conservative regulated entities that they want a gatekeeper or they want a regulator to tell them it's okay. And so I think that at some point, if you want an insurance company portfolio manager to buy the product without knowing what it is or why they bought it, then it would be beneficial for the Basel rules to evolve and get an embrace of Bitcoin as a legitimate asset. Right now, we're selling to informed investors that want to buy the best thing. And if you look at that market, if we slurped up 10% of private credit, that's 370 billion right there. And so we've got plenty of runway for the next decade. But my wish, if I had one wish, is for the Basel rules to be fixed, and then for the world to recognize Bitcoin as legitimate collateral pari passu to gold or to other capital assets on banking balance sheets and regulated entities. Then it should spread faster through the banks as a reserve asset and through insurance companies and the like. But it's not necessary to us. We could be a multi-trillion-dollar company and sell $400 billion of STRC and not have that fixed.
One thing I'll add, Randy, is Stretch is already a rapidly accelerating product in the category of digital credit. And that is without clarity as it relates to tokenization of securities, which I think will either be created through the passage of clarity or rulemaking by the SEC. That will only accelerate things. So we showed $270 million of layer 2 tokenized Stretch from companies like Apex and StockX by Kraken. Those are sold outside the US, not in the US. right? And so when we get clarity, that'll only accelerate things and will accelerate layer 2 development on top of Stretch and just accelerate digital credit overall. So it's exciting to see what may come on something that's already an exploding asset class.
That's great. Thanks.
Thank you, Randy. I was just saying, saving the best for last, James Lavish.
Thank you, CJ. Congratulations in your new role. Fong, Michael, Andrew, thank you for having me and allowing us to ask questions. So, but first, congratulations also on your success with Stretch. You know, I'm a believer in the digital credit world. And I appreciate you all sharing the many levers that you can now use to create value for the common shareholders while protecting creditors. But on that, with strategies, energy, and focus on Stretch, which you've said before is a security you landed on through iteration, what do you see as the optimal future balance sheet structure for maximizing the accretion of value for common shareholders? And would that include retiring most or all of the other debt and preferreds currently outstanding? And do you believe that that's ultimately necessary to attract more of the largest institutions to invest in Stretch in lieu of traditional yield generating securities?
Yeah, we think we want to be debt free completely. So all 6 of the converts we make go away by either swapping them for Stretch or swapping them for equity or paying them off with cash. So I think there's consensus on that. I think there's consensus that Stretch is the killer strong credit instrument. I think the jury is still out on the other 4 credit instruments. They're all long duration credit instruments, and they represent important optionality for the company. And so I think that our policy will be to retire the 6 convertible bonds, to promote and to polish the jewel in the crown, which is STRC, and then to watch and nurture the other 4 and improve them as we can, and then observe whether or not they're material in generating demand. I think right now you can imagine the company, if I was designing a Bitcoin treasury company from a clean sheet of paper, the company would consist of 1 common equity, 1 monthly or semi-monthly variable preferred equity, and a big stack of Bitcoin and nothing else. Right? That's my advice I give freely to anybody that ever asks me. The other things are interesting, maybe, but not necessary. We'll watch them. It's very difficult to create a publicly traded instrument like Strife or Stride or Strike. So we won't retire it because it represents giving up billions of dollars of optionality. But on the other hand, what really is critical for us is manage the common stock carefully to get the MNAV up and the premium up, manage the Bitcoin stack, and then manage the monthly variable rate preferred, the digital credit instrument. Those are the things that really matter.
Thank you, everyone. That brings us to the end of the Q&A session. I'd like to thank everyone for their questions and all the attendees for joining and listening to the earnings call. I'll hand it back to Fong for any closing remarks.
Yeah, I want to first thank everybody for attending our earnings call. I know there's tens of thousands of you out there spending 2 hours and 15 minutes of your evening with us. And we find that to be very gracious and flattering. Many of you are shareholders of our common MSTR and our perpetual preferred Stretch. And as many of you know, we have a shareholder vote coming up that's due early June to primarily modify Stretch to go from, as Andrew mentioned, a monthly dividend to a semi-monthly, twice-a-month dividend. We believe this is beneficial to our shareholders. As we mentioned, one of our principles is to make Stretch better and more attractive. So we would appreciate you all voting early so that we can start to tabulate the votes. And this is how you can do it. If you have additional questions on how to vote for Stretch and for the common, you can also go to our website. And with that, I really appreciate your time. Thank you for all the interest and the attention. And we'll talk to you again, if not before then, at our next earnings call 3 months away. Thank you all.
Well, what do you guys think? Tyler Rowe back here with BitcoinTreasuries.net, and that was a wild earnings call from Michael Saylor, Fong Li, and the team from Strategy. Yeah, lots to chew on, lots to digest. I think the big headline and takeaway from this is that Strategy is indicating, more forcefully that they, in fact, Michael Saylor said they will sell Bitcoin. So the way I kind of view that is that they indicated this. Saylor went down a number of scenarios on the times when Strategy will sell Bitcoin, and it's primarily as a tool to defend against short sellers and to increase Bitcoin per share at the same time. So I see it as a way of kind of helping defend their MNAV, which came under a lot of pressure, in the back half of last year among some famous short sellers who were arbitraging Bitcoin and Strategy that kind of coincided with a drop in Bitcoin's price. And that kind of clobbered the MNAV and sentiment on Strategy stock. So this is another pivot from Strategy. A big takeaway I have from it is that Michael Saylor and co. are always willing to adapt to the market, to be innovative in the market, and to respond when the share price isn't behaving in the way they want, and to basically make the flywheel more productive to really increase that Bitcoin per share. So one of the things I know that people will be critical of, and I've already seen it in the comments a bit, is that they said they'll sell STRC to buy Bitcoin, and then use the Bitcoin they bought to fund dividends while potentially fixing the USD reserve or growing their USD reserve, which is there to increase their credit quality. And they did indicate that selling Bitcoin is an admission, that we're going to take a little bit of hit on credit quality from that perspective, because the entire capital stack isn't collateralized by as much Bitcoin when they sell it, obviously. But they are kind of like using that part of their toolkit to defend against short sellers and to increase that Bitcoin per share. So seems like, again, people are going to be critical. Saylor said so many times, you never sell your Bitcoin. Strategy did sell Bitcoin once just for some tax reasons because of the the adverse way that it was treated on a tax basis. But yeah, just really interesting stuff to see, and it'll be interesting to see how the market digests it. Just looking at Strategy's price after hours, it is down 2.8%. I wouldn't read a lot into that. I don't think that's the market necessarily responding specifically to the call. We see a lot of volatility and a spike in implied volatility around earnings. So that's kind of par for the course. Being down almost 3%, for a stock that's not as volatile may have a big indication, but I don't think we can read too much into that yet. But let me know what you guys think. Drop your comments in the chat. I'll go through some of the chat backlog here. We had some conversation about the selling of the Bitcoin from Michael Saylor. Someone said, I wonder how many shares all the skeptics here own. My guess would be none, since they haven't done any homework, obviously. Yeah, there are a lot of bears. People critical of strategy, so to speak, in the chat. There's somebody, Brando1221 says, I've been in MSTR since 2022, and I'm still a skeptic. Great line. And then Mega General 23 had a lot to say about this. He says the mistake was being so adamant about never selling Bitcoin, not the decision to allow it now. And yeah, there's definitely some merit to that. Bitcoin in Chess says own spot Bitcoin and store in your own hard wallet. That's the only logical solution. This call is not good, and I'm a Saylor fan, MSTR shareholder, and stretch holder until now. Ooh, big words from Bitcoin in Chess. Yeah, stay humble, stack sats, right? Take some self-custody Bitcoin. that's what Saylor's doing. So, you know, he's got the playbook out there for us all, you know, and those of us who were to Bitcoin before him, those of you out there, obviously the value prop of Bitcoin grows and grows each day as you know, governments continue to spend and print money. Mega General says lots of things can happen in Bitcoin wallets too. My portfolio is spread out, including MSTR, physical gold and silver, real estate, collectibles. Certainly a diversified strategy is something that can definitely happen, and I think is appropriate for most people when they're analyzing their overall portfolio. Again, more comments about Saylor has making a point of saying that he'd never sell. Get in the comments, guys. Let us know what you think about this call from Strategy. Still got a few thousand of you watching out there. Right. Yeah, I put a comment in there, you know, that I was appreciative they're willing to respond to the market. In the past, I've added a US dollar reserve to kind of respond to some of this, you know, FUD that's out there about them not being able to fund the dividend payments. Of course, they've been really responsive. Last summer, when Strategy and team said they wouldn't issue common equity below 2.5x MNAV, they were quick to reverse course on that when they realized that wasn't, you know, a sustainable model if they wanted to accumulate as much Bitcoin as possible and drive accretive Bitcoin per share. All right. Yes, people are encouraging everyone to vote yes with their strategy shares, with their stretch shares for the semi-monthly dividends. It seems like it'll be a slam dunk, you know, it's just a win-win for everybody to have those twice monthly dividends on STRC paid out. It will kind of dampen some of that volatility and some of that arbitrage that comes in with traders around the ex-dividend date. And, you know, for anyone who wasn't sure or hasn't caught a video from Fong and Michael Saylor talking about, you know, offering these dividends twice a month. Why aren't they doing it, you know, every week? Why aren't they doing it every day, you know, paying dividends more frequently? There are some NASDAQ rules and SEC rules that are in place where you effectively can't pay out dividends or have a record date more than twice per month. So that's the reason they're kind of tethered to the 2 times per month. And of course, Strive's SATA will likely be moving, I think, to a 2 times a month payment on an alternating weekly cadence with Strategy. So you'll be able to pick up dividends 4 times a month if you're a holder of digital credit in U.S. markets with the STRC and the SATA product from Strive. Yeah, so like I said, what do you guys think? Drop some comments out there. We'll be talking about this. We'll continue the conversation on X. Yeah, I find it interesting when there's one point where Saylor said they could retire all the convertible bond debt that they have on their balance sheet if they just allocate, you know, forward-looking, of course, 20% of their stretch issuance to increase their Bitcoin per share. So, yeah, within 3 years, retiring all that convertible debt. I think the last convertible bond is set to mature in 2032. Let me just check those numbers. Yeah, I'll flash that up here on the screen, so you guys can take a look at all the credit metrics here. Yeah, so yeah, you take a look. You've got the US dollar reserve of $2.25 billion. You've got convertible debt from 2028, 2030, 2031, 2032. So there's another $8 billion of notional value from those converts. I guess the cumulative notional is almost $6 billion, and that debt is all going to be retiring, you know, automatically and converted into common equity of Strategy shares. You know, the people they issued those convertible bonds to, they've all been delta hedged out at this point. But you know, to prevent further dilution, they are going to retire those. And Michael Saylor says they can do that hypothetically by 2029. So accelerating the process essentially by 3 years if they just move 20% of the expected STRC issuance where they're ATMing stretch to retire that money. So in the past, Saylor said, you know, they'd consider raising money via the common stock or the preferreds to raise cash to retire this debt, but only usually about a year, 18 months ahead of time, potentially. But this, him kind of framing and teasing that they could retire it all within 3 years with current stretch trajectory is interesting, and I think would be bullish for cleaning up that balance sheet. It's since they've moved away from the convertible debt and the some of the other more traditional debt that they had on their balance sheet, which has been retired. They've wanted to clean up the balance sheet and keep it all perpetual, keep this amplification. They don't call it leverage because it's not exactly a loan. These preferred equities are just a perpetual debt or perpetual obligation to pay dividends into the future. And crucially on STRC, they've got the ability to affect that rate change on a month-to-month basis. So they can drop it by 25 basis points, 0.25% every single month, when the market demands. If excess demand is coming into STRC, they can drop that rating. If the SOFR overnight funding rate is headed downwards, there's pressure from the markets and from the banking system to lower interest rates, then strategy uses stretch as basically offering that Bitcoin exposure by offering a credit spread above the so-called risk-free overnight rate. So yeah, lots of ways to handle this. It will be interesting to see how you guys take the news that they look more indicative that they will sell Bitcoin. Saylor said they're going to actually do it. I don't think it's going to be a lot of it, but he said below 1.22x MNAV, and I think that's their enterprise value MNAV that they use in their calculations. That's when it's accretive to Bitcoin per share. There are companies out there like, and I think we might see some follow in their footsteps, but Empery Digital's out there, and they're really focused on that Bitcoin per share, and they've been willing to sell Bitcoin to defend that MNAV in the marketplace. And I was talking with their CEO Ryan Lane a couple weeks ago, and he said their investors are so aligned. That's exactly what they're there for. They're there for that trade. They're there to have accretive exposure to Bitcoin on a per share basis. So it'd be really interesting to see a strategy move a little bit in that direction. I do wonder if it's more of a signaling thing to kind of decrease short interest or coordinated short attacks on the share price or on the common equity of MSTR. So if there is a move like happened last summer, last fall, where there were people arbitraging MSTR against the price of Bitcoin at large scale, until they unwound their positions. I do wonder if just the threat of that being there and strategy selling their Bitcoin from time to time below that 1.22 MNAV will discourage that type of activity or not. The market's going to do what the market's going to do, and Adrian Morse is constantly talking about a company really can't control MNAV. There's certainly things they can do to influence sentiment, but the market's going to do what the market's going to do. So key things to look forward there. Some other things that Saylor hit on, I was taking some notes. He said to think of stretch as a perpetual swap and not a loan obligation. We kind of touched on that, where strategy, the issuer agrees to pay back that credit spread, and there Michael Saylor and Fong Li and team are happy to take on the volatility risk of Bitcoin because they think it's going to continue to appreciate 25, 30 plus % per year, and they're happy to pay out that 11%, 10%, whatever the number may be in the future, as they use that capital to strengthen the balance sheet and strengthen the credit risk of the company. Because anyone who's buying strategy common stock obviously has some conviction in Bitcoin long term. So the more capital, digital capital in Bitcoin that you can add to your balance sheet does, in the eyes of investors, really help strengthen that credit risk rating. So they did say, crucially, Saylor, when he was outlining that they will sell some Bitcoin, that does increase the credit risk of the company, as there's less of a collateral base there. But yeah, like I said, I think it's just more signaling of what guarding against those short sellers in the marketplace. So cool stuff. Yeah, lots to ponder, lots to digest. We'll be bringing you some breakdowns, and we're going to have some really good conversations, I think, about this in the coming weeks. And I'm sure Saylor and Co will be out there talking more about it. And as the market digests this, Bitcoin's price has been on the move. We're above 80,000. We tagged, I think, 82,000 per Bitcoin today. So that's something that can kind of take these Bitcoin treasury companies like Strategy out of the doldrums, and Strategy's been up 40-45% over the past month. And if Bitcoin's price continues to climb, we'll definitely see Strategy follow suit, as it is an amplified trade or investment on Bitcoin. So yeah, really cool stuff. And I think Saylor's also kind of targeting people who want some more hedge fund like returns but don't have access to that with MSTR common stock, and by really laser focusing on the Bitcoin per share increase, I think that you're going to see a broadened investor base. I think there will be some MSTR shareholders who might be disappointed that they'll sell Bitcoin after years of Saylor saying you never sell your Bitcoin. But I think like many times when Strategy pivots and changes direction, a lot of the MSTR shareholders are invested because they trust the team at Strategy. They trust Michael Saylor to make the right decisions for his company. So really, really interesting stuff to see. And for my own personal perspective, and not financial advice, of course, is that it really depends on how aggressive Strategy gets with this. And it sounds like they're not going to be super aggressive, but they want to have the threat out there. They want the market to digest that, hey, they will sell some Bitcoin. So really, really, excuse me. Sorry, guys. It's been a long day talking behind the mic, but yeah, I think it'll be really cool to see how the market digests this. I do think this might make them even more of a bigger target for indices who want to label Strategy as a financial company who's just engaged in financial engineering. And there's some indices who don't put financial companies into their indexes, and they don't. Maybe the argument might be that Strategy doesn't represent the broader market, U.S. markets, global markets, whatever it may be, because